Let us start with the session for mock test paper October 2020 for SFM in CA final. Let us start with this session. As what we do normally, friends, first of all we are going to discuss the entire examination paper, and then we are going to have an understanding of the analysis. What may be the sequence in which you should be doing answer, what may be the question that say you may skip, what is the length of the question, how can we have an idea before we attempt the question, all those things that we are going to have a very good understanding over here. So starting with the mock test paper of October 2020. Starting with the question number 1A, dear students, Derivative Bank entered into a swap arrangement. Swap means interchange on a principal of rupees 10 crore and agreed to receive MIBOR, that is Mumbai Interbank Offer Rate. It is the floating rate of interest, overnight floating rate for a fixed rate payment on the notional principal. So derivative bank is going to receive at floating rate and it is going to pay at fixed rate. The swap was entered into on Monday 19th of August 2019 and was to commence from 20th of August 2019 and run for a period of 7 days. So for 7 days, so the swap arrangement is going to continue. Respective MIBOR rates for Tuesday to Monday were as under. Okay. So this is the rate provided to us for Tuesday. Okay. This is Wednesday. Then it is Thursday. It is Friday. It is Saturday. It is Sunday. Where is Monday? Oh no sir, it is not like that. Saturday and Sunday it is together. Why? Because Sunday is holiday. And the last is the Monday. This is the way we are required to understand. So we have been provided with the floating rate for Tuesday, for Wednesday, for Thursday, for Friday, Saturday and Sunday it is the same, and for Monday it has been given. If the fixed rate is 8%, then evaluate the nature of the swap, that is arrangement, and the net settlement amount. It means that we understand, let's say better the floating rate is more in comparison to the fixed rate. So the difference of that will be calculated and set is required to be adjusted, that is between both of them. You can see that, listen to me carefully, derivative bank is going to receive floating. So just as I told you that if at all the floating rate of interest is more than the fixed, then the difference will be received value. Reverse, if at all the floating rate is less, that is amount of interest calculated based on the floating rate is less in comparison to fixed, then in that case you are required to make the payment. Notes, Sunday is a holiday, yes. Work out rounded rupees and avoid decimal working. Thank you for providing this clarification. Consider 365 days in a year. Again, thank you for providing this clarification, because number of times they take 360, 365 and no conceptual point, but still as a student I have number of confusions. That is the reason. Okay, so now we will make the computation of the amount of interest in two legs. The one is the floating rate and another is the fixed rate. So the floating rate of interest will be calculated and the fixed rate of interest will be calculated. That is the way. So the two rate of interest, that is using the different methods that they have provided, will compute the interest amount. Okay. So now working note number 1, calculation of interest in floating rate. There is no need to write the date you may write only day, or otherwise you may not write the day and you write the date. Either of that, so you can do it, friends. Day, then amount on which interest is calculated, and interest amount. I am starting with the date, dear students. So starting with a Tuesday. For Tuesday, the amount on which the interest is calculated is, I think, 10 crore. Yeah, 10 crore. And what is the interest amount, dear students? Amount of interest will be calculated as 10 crore into, what is the rate of interest? Rate of interest is 8.15% into 8.15% into 1 divided by 365. So dear students, the amount of interest is going to be 10 crore into 8.15% into 1 divided by 365. It comes to 22,328. That is the interest, or we can say it is 329 because it comes to 0.76 later on. So 22,329. Now dear students, over here importantly, the interest for the subsequent day will be calculated on daily compounded basis. Over here they have provided clearly that say avoid decimal working. That is the reason I am not writing any decimal. As far as the Wednesday interest is concerned, it will be 22,329 plus 10 crore. This is the amount on which it will be calculated. So in that case, the value is, that is the amount is 1,000,22329. Okay. The next day rate of interest is provided to us as 7.98%. So 10 crore 22,329 into rate of interest is 7.98, yes, into 1 divided by 365, yes. So this into 7.98%, fine, divided by 365, that is okay. 21,868, that is what we understand. 21,868, that is interest for the second day. Wednesday, then Thursday. For Thursday we understand that the rate of interest is 7.95%. So here Thursday, this amount of interest 21868 is added to 10 crore 22,329. So it comes to 10 crore 44,197. Into, what is the rate of interest? 7.95%. Into 1 divided by 365. Okay, so the amount of interest comes to 21,790.45. So I am taking 21,790. So the interest is calculated on 10 crore 44,197. Then it is Friday. Okay. Next day, it is 21,790 plus 10 crore 44,197. So this is the amount on which the interest is calculated. It is 10 crore 65,987. So 10 crore 65,987 into, for Friday the rate of interest is 8.12%. So it is 8.12% into 1 divided by 365. So this into 8.12%, okay, divided by 365, okay, it comes to 22,261.25. So we'll take 22,261. Okay, next we are required to compute the interest. Now dear students, you have been provided with the same rate of interest for Saturday and Sunday. So of course we are required to understand by applying common sense that the interest for Saturday and Sunday will be calculated combined. So it is 10 crore 65,987 plus 22,261. So it is 10 crore 88,248 into the rate of interest for Saturday and Sunday is given as 8.15%, dear students. So into 8.15% into 2 divided by 365. Because for 2 days the interest will be computed together. So into 8.15% into 2 divided by 365. So the interest is 44,697. 44,697. That is the interest. Okay. That is the interest for Saturday and Sunday together. ₹10 crore 88,248. After this Monday, okay, for Monday it is 10 crore 88,248 plus 44,697. So it is 10 crore 1 lakh 32,945 into the rate of interest is provided to us as 7.75%. 7.75% into 1 divided by 365. So into 7.75%, okay, divided by 365, fine. 21,261. 21,261. 0.10, however we are ignoring it, that is the interest. Okay, this is the way we will make the computation of the total interest amount based on the floating rate. Now we are required to make the total, because it has been given that the derivative bank is going to receive the interest at MIBOR. So amount of interest income that derivative bank is going to receive is 22,329 plus 21,868 plus 21,790 plus 22261 plus 44697 plus 21261, and the total comes to 1,54,206. So it is going to receive this amount 154,206. This is the amount of interest to be received. Now we will compute the interest to be paid at the rate of 8%. So we understand that the interest is calculated on daily basis. For Tuesday, for Wednesday, for Thursday, for Friday, for Saturday and Sunday it is combined, Monday, and that is the way the total interest is calculated. This is the amount of the interest which the derivative bank is going to receive at the floating rate. Now, working note number 2. Very simple working note, dear students. In that, calculation of the interest amount, at fixed rate of interest. Now, what is the fixed rate provided to us? Fixed rate is provided as 8%. So, in that case, interest is equal to PRN upon 100. The principal amount is 10 crore. Yes. Rate of interest is 8%. Fine. Time period is 7 days. So we understand that the 10 crore into 8% into 7 divided by 365. The amount of interest comes to 1,53,424.65. So we can say that it is an amount of rupees 1,53,425 because we are required to round off the values. Okay. Now we'll compute the difference. Calculation of difference. I am writing over here interest received minus interest paid. Dear students, I am doing the working from the derivative bank point of view. So it is going to receive the interest. How much, dear students? 154,206. 1,54,206. Interest received minus interest paid. Dear students, I am doing this working from the derivative bank point of view. Why? Because the derivative bank is going to receive the interest at the floating. So what amount of the interest that it is going to receive is this 154,206 minus it is going to make payment of interest 153,425. So the difference of both of them comes to 781. As the answer is positive, we understand that the derivative bank is going to receive. So we understand that the one line answer that I am writing. Derivative bank is going to receive rupees 781 with swap arrangement. This is the way we are required to write the answer. Okay. Now question number 1b. Let us see the next question. Okay. The information is provided like this. The following are the data on 5 portfolios. There are 5 portfolios provided to us. Portfolio A to portfolio E. Returns have been given. Standard deviation have been given. Beta have been given. You are required to evaluate the reward to volatility of these portfolios using Sharpe method, using Trainer's method. Assuming that the risk-free rate of return is 6%. So dear students, we are required to make the computation of the reward to volatility using the Sharpe ratio and Trainer's ratio. Okay. We understand that over here, as far as the Sharpe ratio is concerned, it is calculated by taking into account the mean return, risk-free rate of return and the standard deviation of the security. So you can see that the standard deviation is given yes, return is given yes, and risk-free rate of return is given yes. So we'll make the computation of the Sharpe ratio, and of course we understand that the security which is having the highest Sharpe ratio is given the first rank, and that is the sequence in which we are required to keep the remaining securities. This is what we are required to do. As far as the trainer's ratio is concerned, friends, trainer's ratio is taking into account the beta. As far as the beta is concerned, beta is a measurement of the systematic risk. Sharpe ratio is taking into account the total risk, and the trainer's ratio is taking into account only the systematic risk. That is the difference that we have in both of them. Let us make the computation first of all, and then we'll do some analysis, even though the question does not provide us to make any such analysis. Write down heading Sharpe ratio. In that, write down the formula. It is additional return divided by additional risk. The term additional return stands for mean return x bar minus RF divided by additional risk is standard deviation of the security minus standard deviation of risk-free security. In absence of an information, we assume that the standard deviation of the risk-free security is 0. So what will happen, dear students? It is x bar minus RF, that is the additional return, divided by the standard deviation of the security. That is the way the Sharpe ratio will be calculated. This is what we are required to do. Okay. Now listen to me carefully. Column number 1 I am writing security. Column number 2 I am writing over here Sharpe ratio. How we will compute, friends? It is x bar minus RF divided by the standard deviation. That is the way it will be calculated. Okay. So let us start one by one with the answer. We'll start with the security A. Return is how much? 15%. Risk-free is 6%, which is provided over here. Divided by standard deviation is 7. So 15 minus 6 upon 7. So 15 minus 6 upon 7. That is the way the Sharpe ratio is calculated. So 9 upon 7, it comes to 1.2857. Just be careful that say whether they have provided any instruction with respect to any number of decimals in which you have to do answer. If yes, then we'll do answer accordingly. B security. In that, return is 18, standard deviation is 10. So it is 18 minus 6 divided by standard deviation is 10. Answer is 1.20. C security. In that, it is 14 minus 6 upon 5. 14 minus 6 upon 5. So it is 8 upon 5. So it is 1.60. Security D. In that, it is 12 minus 6 upon 6. So the answer is 1. E security. 16 minus 6 upon 9. So I think it is 10 upon 9. Yeah, 1.11. Dear students, the Sharpe ratio is indicating that what is the return that you are able to get for every 1 unit of additional risk that you make in the investment. We understand logically like this. As an investor, when I make investment in a security, my additional risk is 7%, in comparison to this period, and my additional return is 9%. So for the additional risk of 7, my additional return is 9. So for every 1 unit of additional risk, my additional return is 1.2857. Okay, this is the way we have set a Sharpe ratio, and then we do the ranking. Okay, the rank is supposed to be given. C security is given the first rank, then A security is given the second rank, then B security is given the third rank. Pardon me if I am committing any mistake. This is fourth rank and this is fifth rank. This is the way, so we have the ranking. So it is 1.6, yes, 1.28, lower, 1.20, yes, going down, 1.11, yes, and then it is 1. This is the way we are required to make the computation of the Sharpe ratio for each of the scale. Next, we are required to make the computation of the trainer's ratio. As far as the trainer's ratio is concerned, it is calculated as x bar minus Rf divided by beta of the security. This is the way it is calculated. Again, the logic is the same. Additional return divided by additional risk. Additional return is x bar minus Rf divided by additional risk is the beta of the security minus beta of the risk-free security. And we understand that so the risk of the risk-free security is 0. So accordingly we make the calculation of answer. Column number 1 is again security. Column number 2 is trainer's ratio. So x bar minus Rf divided by beta. Lastly again we are going to give rank. Okay. Starting with the security A first of all. Okay. For security A, the return is 15, Rf is of course 6, and beta is 1.25. So 15 minus 6 upon 1.25. B security 18 minus 6. C security 14 minus 6. D security 12 minus 6. E security 16 minus 6. Okay, this is the additional return that we have divided by additional risk, that is the beta of the security, that is 0.75, okay, 1.40, okay, 0.98, fine, and then 1.50. So this 0.75, then it is 1.40, then it is 0.98, and then it is 1.5. Okay, so now 15 minus 6 is up again 9 upon 1.25, that comes to 7.20. Then 12 divided by 0.75, that comes to 16. Then 8 upon 1.4, 5.7143. Then 6 upon 198, 6.1224. Ten upon 1.5, 6.6666 or 67. Okay, this is what we have. Dear students, after that we will give the rank. 7.2, 16, 5.71, 6.12. Okay, I think that the first rank will go to the B security, second rank will go to A security, third rank will go to E security, fourth rank will go to B security, and fifth rank will go to C security. That is the way we are supposed to give the rank to the individual security. So now this is the way we make the computation of the trainers ratio and we do ranking. Just for understanding purpose, I am writing the securities in the order of the ranking. See, I am writing over here the Sharpe ratio. Then I am writing over here trainers ratio. I am writing ranking based on that. It is CA, B, ED, CAB, ED. This is the ranking that we have. CABDE. And for the next one it is BAE, B and C. Now what happens, I'll say, dear students, number of times we are asked with a question that say why there is a difference in the ranking. We are required to answer that say why there is a difference in the ranking. If at all we have been asked with such question, then in that case we have to answer that so the Sharpe ratio is measuring the total risk and the trainers ratio is measuring only the systematic risk. So there is a difference in the ranking. And suppose the rankings are same, suppose. Even in that case the question can be there that say why the ranking is same. Then we have to answer that so the total risk must be consisting of the majority systematic risk, so the ranking is same. This is the way say we understand that say we are required to give comment for the Sharpe ratio as well as trainers ratio. I am writing a note over here just for understanding purpose. Whenever there is a difference in ranking, comma, in that case we understand that it is due to the factor that Sharpe ratio is calculated using standard deviation which measures total risk and trainers ratio measures risk in form of beta comma, it measures only systematic risk. This is what we understand. That is the way we are required to say right answer. In this question, this point is not there, but this is only for the understanding purpose. Next question. The question says that explain the problems that are faced in international capital budgeting decision and how these can be overcome. Answer of the question is very simple. That's why we are required to mention over here that what are the additional issues that say you are facing when you undertake a project overseas. The various types of problems faced in international capital budgeting analysis are as follows. Multinational companies investing elsewhere are subject to, of course, the foreign exchange risk. In the sense that the currency appreciates or depreciates over a span of the time. To include the foreign exchange risk, the cash flows estimate of any project, it is necessary, it is essential to forecast the inflation rate in the host country during the lifetime of the project. Adjustments for the inflation are made in the cash flows debit side in the local currency. The cash flows are converted in the parent company's currency at the spot exchange rate multiplied by the expected depreciation obtained from purchasing power parity. In short, you are required to make a forecasting about the exchange rate which is going to prevail. Dear students, we understand that when I say that it is the capital budgeting, it means that I am talking about the long-term horizon. If at all I am talking about the long-term horizon, then in that case, during this time period, of course, there will be a situation that the exchange rate will change during this time period. Of course, we make an estimation of the exchange rate which is going to prevail. At the same time, there are a number of things which are out of your control. As there are a number of things which are out of your control, that is the reason we are required to incorporate that kind of uncertainties also in the decision making process. Due to restriction imposed on the transfer of the profit, depreciation charges and the technical differences exist between the project cash flows and the cash flows obtained by the parent organization. Means the cash flows of the project and the cash flows received by the parent organization, both of them differ number of times due to the timing difference. Such a restriction can be diluted by the application of the techniques, namely internal transfer prices, overhead payments, adjustment for the blocked funds, depends on its opportunity cost, a vital issue in the capital budgeting process. Third, multinational capital budgeting after-tax cash flow need to be considered for the project evaluation. The presence of the two tax regimes along with the other factors such as the remittance to the parent firm in form of the royalties, dividend, management fees, etc. Tax provisions with held in host country, presence of the tax treaties, tax discrimination pursued by the host country between the transfer of the realized profit vis-a-vis local reinvestment of such profit cause serious impediments to multinational capital budgeting process. All those things are going to have like the big impact on the profitability, on the cash flow. So these are the additional challenges that you need to cater in your capital budgeting process when it comes to international capital budgeting. MNCs are in a position to reduce the overall tax burden through the system of the transfer pricing. For the computation of the actual after-tax cash flows occurring to the parent firm, had the home or host country tax rate is used. If the project becomes feasible, then it is acceptable under a more favorable tax regime. If not feasible, then other tax savings aspects need to be incorporated in order to find out whether a project crosses the hurdle rate. This is the way we understand that the additional factors are required to be considered in capital budgeting process. Next, question number 2A. You as a dealer in foreign exchange have following position in Great Britain pound on 31st of October 2019. Balance in the nostro account, and that is the credit balance which you have, an amount of 2 lakhs. Opening position is overbought, means the purchase is exceeding the sale, by 1 lakh. Purchased a bill on London 1,60,000. Sold forward telegraphic transfer 1,20,000. It is a forward transaction. Forward purchase contract entered upon earlier has been cancelled. Remitted by telegraphic transfer. Draft on London got cancelled. Decide the steps you would take if you are required to maintain a credit balance of 65,000 UK pound in the nostro account and keep oversold position of 20,000 UK pound. Like that information is given. So dear students, this is a question of the foreign exchange risk management, and over here we are required to prepare the exchange position as well as nostro account. So please write an answer along with me if at all you are writing answer. Answer of question number 2A. In that nostro account, we are required to prepare in pound currency term. In that it is particulars, debit and credit. Then exchange position, in that again particulars, then debit, that is purchase, and sale. That is the way we are required to start, and we have to incorporate all the transactions which have been provided to us. A few transactions will be affecting both, and a few transactions will be affecting only one of them. So taking into account one by one all the transaction, that is each of the transaction, we are required to work out the answer. Let us start with the answer. The question is providing the information to your students that the balance in the nostro account credit is an amount of 2 lakhs. So in the nostro account, we understand that we have an opening balance of rupees 2 lakhs. There is a credit balance of 2 lakhs. Okay. Then information is given that opening position overbought 1 lakh. So the exchange position is given that opening balance overbought by an amount of 1 lakh. Okay. Next is purchased a bill in London 1,60,000. So this is what's a kind of transaction provided to us. What is given to us? Purchased a bill in London. Okay. Now over here, I'm just reading the information once again. You as a leader in the foreign exchange have the following position in the pound, and so on. The information is given. So basically what is your domestic currency is not provided to us. So let us assume that domestic currency is Indian rupees. It can be anything. It is only that the information is given that your account is say in the pound currency term. But let us assume that it is in the Indian rupees term. Then in that case, say what kind of, like the transaction in which you have entered upon, and whether it will have the effect both in nostro account as well as exchange position. That is what we are going to discuss, or it will have the effect only in one. See, this transaction is to be understood like this. one of the Indian company has exported goods to a UK company. Like that information is given. This is the first information. Further it has been given, this Indian company must have given credit for some time to its customer. Full stop. During this time, there is a requirement of fund so it has raised a bill, comma, it is bills receivable for Indian company. So from the Indian company point of view, it is bills receivable. Indian company is discounting bill with its bank. Full stop. So, from bank point of view, comma, transaction is sell of rupees and purchase of pound. Of course, the discounted value, however, we understand it is the sell of rupees and purchase of pound. An amount of rupees will be given to the client, to the bill holder, bills receivable holder, and against that, say, the pound is going to be received not right now, but the date on which the bill is going to mature. So we understand that, say, right now it will not have the effect in the nostro account. It will have the effect in the nostro account when this bill will get mature and this foreign exchange dealer or the bank is going to get, say, this amount in the pound currency. So right now there is no entry in the nostro account, there is only entry in the exchange position. This transaction will have effect only in exchange position. We understand, friends, over here that the bank is entering into the transaction for purchase of pound. Yes, so over here in exchange position, in the purchase I am writing bill discounting. What is the amount? The amount over here is 1,60,000. So we mention over here 1,60,000. Okay. Next. Sold forward telegraphic transfer 1,20,000. So the transaction which has been mentioned over here is transaction is sale forward telegraphic transfer. That is a transaction. Let us understand and say how to understand this transaction. See, over here we have to understand like this, that there must be an Indian company which must have imported goods and it is required to make payment in UK pound. Whether the payment is to be made right now? No. In forward transaction. That is later on the payment is required to be made. So this Indian company is entering into the forward contract. What is a forward contract? Sell of rupees and purchase of pound. Okay. So this is the contract which has been entered upon, say, by the Indian company with whom? Say, with the bank. So what the bank is required to do? Bank is required to enter into the transaction for sell of pound, okay, sell of pound and purchase of rupees. That is opposite of this transaction. Again, is it required to be entered upon right now? No, it is required to be entered upon, say, in forward contract. So again, what will happen? Say, right now it will not have any impact in the nostro account. It will have the effect only in the exchange position. In exchange position, friends, we will be having, say, the sell of pound. So we understand that over here, say in the exchange position, we will write the sell. Okay. In that, say, sold forward telegraphic transfer. When actual effect will be there, then in that case its effect will be there in the nostro account. That is an amount of 1,20,000. So over here, in case of sale column, we will have 1,20,000. Okay. Next, remitted by telegraphic transfer. Forward contract, forward purchase contract cancel. Okay. Now, again understanding the transaction. Forward purchase contract cancelled. We understand that, say, earlier forward contract was entered upon. Earlier forward contract was entered upon. For what? So for purchase of UK pound. So we understand it is purchase of pound and sell of rupees. This was the initial contract entered upon. Okay, it was forward. So of course we understand that it must not have been given effect in the nostro account. It must have been given effect in the exchange position. Now cancel means in the purchase column you have to return it. So now you cannot cancel from the purchase column. You are required to write in the opposite column. That is, from purchase it will be sell of pound and purchase of rupees. We are required to see the transaction in the foreign currency, and in foreign currency it is the sell of pound. So we will have simple answer. Forward purchase contract cancelled. Okay. What is the amount? Amount is provided to us as 60,000. So this comes to 60,000. Next, remitted by TT. So over here, not the forward, but right now the transaction is entered upon. So we understand like this. Listen to me carefully. This transaction itself has been entered upon. An Indian company imported goods, payment to be made in UK, and instead of forward contract, spot transaction is entered upon. What is spot transaction, dear students? Spot transaction will be sell of rupees and purchase of pound. So what the Indian bank or Indian foreign exchange dealer will tell to its client that the amount of pound that say you are required to make payment to your supplier, we will make that payment through the account that say we have in UK, and so the equivalent amount of the rupees we will take from you. So as far as the bank is concerned, from the bank point of view, the transaction is sell of pound and purchase of rupees. So this will have both the effect. It will have the effect in the nostro account as well as it will have the effect in the exchange position. In exchange position, we understand it is the sell of pound. So remitted by TT, what is the amount? The amount is 1,50,000. Okay. Further, we understand that over here that it will have the effect in the nostro account also. So we will mention over here remitted by telegraphic transfer. There is a debit effect of 1,50,000. Okay. Next. Draft on London cancelled, an amount of 60,000. So draft cancelled. Okay. Let us have understanding that say how this transaction is required to be understood. See, we have to understand it like this. On a particular day, let us say that a student comes to the bank and the student is telling to the bank that say, I want to get a demand draft of 60,000 pound as I got admission in one of the college in UK. We said okay. So whatever the equivalent amount of the rupees along with the charges we took from that student, and from student point of view, the transaction was sell of rupees and purchase of pound. And we understand that say from bank point of view, the transaction was sell of pound and purchase of rupees. Of course, we understand that say the day on which the draft is prepared, at that point of time, what happens at the bank will issue the DD to the student. When student is say getting admission over there, student is depositing his DD over there. Let us say that say it is of the A bank in which say we have the account. Okay, A bank is the bank in which we have the account. The university or the college in which student has got admission has bank account in the B bank. Okay, B bank. So from B bank, when the draft is presented to A bank, at that time it will have the effect in the nostro account. But right now, when the draft is issued, so there is only a single effect like this. There will be only a single effect like this. I repeat this point again. What happens at say a student got admission in a university or in a college, say in London. So he comes to the bank and asking the bank that say in order to make the payment of the fees, I want DD of 60,000. So what student is doing, friends? Student is selling rupees and purchasing pound. So the student is making payment to the Indian bank for the purpose of getting the DD in pound currency. What bank is doing? Bank says that say it is debiting like the student's account and will issue the DD. Basically, the account of the bank in like pound currency. Suppose it is in the bank A, and the university in which say the student has got admission has account in bank B. So from bank B, when like the DD is presented to bank A, at that point of time the nostro account will be affected. Okay, so this is what say already taken place. Now because of some reason, so the student wants to cancel the draft because of any reason. So what happens is the student will enter into, of course, a transaction which is opposite to this, that is sell of pound and purchase of rupees. This is the transaction in which student will enter upon. And as far as the bank is concerned, of course, the bank will also enter into the opposite transaction. It is sell of rupees and purchase of pound. Importantly, the nostro account has not been affected so far, so we'll ignore the effect of this in the nostro account. Its effect will be there, say only in, we understand that, say the exchange position, in which we'll write in the purchase column. This is the way we have to understand. So the purchase of that is cancellation. So this cancellation of demand draft cancelled. What is the amount? Amount is 60,000. Okay. This is the way we are required to show the transaction. Now, dear students, we have been provided with an additional adjustment over here. Decide the steps. Before we read that adjustment, let us complete the account at this point of time. As far as the nostro account is concerned, we can see that the credit side total is more than the debit side. So credit side total I am doing, first of all, it is 2 lakhs. Debit side also 2 lakhs. So this is the closing balance. In bracket I am writing credit. That is an amount of 50,000. That is the balance that we have. At the same time, we understand that, say, in case of exchange position also, we will be having, say, the same thing. In exchange position, we are required to make the total. Purchase side, the total is like 1 lakh plus 160, so 2,60,000 plus 60, that is 3,20,000. On the sale side, it is 120 plus 60, 180, 180 plus 150, that is 330. So that is the way we are required to make a comparison, and totaling, that is the balance will be calculated. So we can see that the sale side total is greater, like 3,30,000 is the total that we have. So we will be having the balance to be computed accordingly. So we'll calculate the balance over here. So 1,20,000 plus 60,000 plus 1,50,000. That comes to 3,30,000. So the sales side, it is 3,30,000. In purchase side, 3,30,000 minus 1 lakh minus 1,60,000 minus 60,000. So the closing position is oversold. So the closing balance is oversold by an amount of 10,000. That is the way we'll have the closing balance oversold. So now the closing balance is calculated. For the nostro account, we can see it is 50,000, which is the credit balance, and for exchange position, it is closing balance 10,000 oversold. So over here we can write something like this. Nostro account closing balance is 50,000 credit, 50,000 credit, and exchange position. It is again the closing balance. It is, I think that's it is 10,000 oversold. Like that's the situation that we have. Now reading further the requirements which they have provided. Decide the steps you would take if you are required to maintain a credit balance of 65,000 pounds in the nostro account. Okay, in the nostro account I desire to maintain the credit balance only. However, I want the credit balance of 65,000. This is what I require. Further it has been given, and the keep oversold position. I want oversold position only 20,000. Okay, I want oversold, however it is 20,000 oversold position I require. Like that information is given. Let us have understanding, let's say how to do this answer. Now, dear students, from 50 to 65, how we can move? Simple. You can purchase difference of this, that is 15,000 UK pound from spot market. We understand like this. In order to get closing balance of nostro account in order to get the closing balance of 65,000 pound, comma, dealer should enter into spot transaction to buy 15,000 pound. In bracket I am writing 65,000 minus 50,000, so that credit balance increase to 65,000 pound, full stop. However, with that, dear students, what will happen as far as the exchange position is concerned, it is also affected. We understand there is an oversold position of 10,000. If you purchase 15,000, then in that case, however, with that, exchange position will be overbought by 5,000 pound. How this 5,000 pound is calculated, dear students? We understand it is 10,000 oversold minus 15,000 purchase. So from oversold it will change to overpurchase. From oversold it will change to overpurchase. How much? 5,000. Okay. Now listen to me carefully. The question is not over. We require the oversold position of 20,000. Okay, so now this over purchase is required to be converted to oversold. How much? 20,000. So we understand that say 20 and 5 differences, like we understand that say the difference of that is like 25, because 5,000 is purchase and 20,000 is the sale. So 25,000 is say like the sale transaction is required to be entered upon. Now what we will do, we understand that say in exchange position, in order to have the sale position, that is oversold position of 20,000, you will sell. But if at all you enter into the spot transaction, then in that case it will affect, that is have an impact on the nostro account also. That is the reason so you will enter into the forward contract. So what will happen? So it will have the effect only in the exchange position and not in the nostro account. So now further answer, it is not only for understanding, it is forming part of the answer. In order to have oversold position by 20,000 pound, comma, dealer should sell 25,000 pound in forward contract. So in forward contract, what will you do? You will sell. How much? 25,000. So 5,000 purchase will be converted to 20,000 sale, and it will have the effect only in the exchange position, not in the nostro account. So over here the word forward contract is important. For that I am dictating an explanation. That explanation is, you may write, you may not write in examination. In order to have impact of transaction only in exchange position, and not in nostro account, comma, forward contract is entered upon instead of spot transaction. Full stop. This is the way we understand is the answer. Next question. It is question number 2B. Sam Limited has just paid dividend of ₹2 per share. Just paid is understood to be D0 and is expected to grow at the rate of 6% per annum. After paying dividend, the board declared to take up a project by retaining the next 3 annual dividend. So once the payment is made, after that, so the board made a declaration that we are going to make investment in a project by retaining the earning from the existing business for the next 3 years. It is expected that this project is of the same risk as the existing project. So very good clarification is made that the new project is having the same risk as the existing project. Even in that case, that is, even if this clarity is not made, we will make that assumption. the results of the project will start coming from 4th year onwards from now. So from 4th year onwards, it will have its impact. The dividend will then be 2 rupee 50 paise per share and it will grow at the rate of 7% per annum. We understand it is the dividend per share at the end of the 4th year is 2 rupee 50 paise and the growth rate is provided 7%. An investor has 1000 shares in SAM Limited and wants a receipt of at least rupees 2000 per annum from this investment. Interpreted how the market value of the share is affected by the decision of the board. Also advise as to how the investor can maintain his target receipt from the investment for the first 3 years and improved income thereafter, given that the cost of capital of the firm is 8%. So over here the question is providing the information like this, that you are required to do the interpretation how the market value of the share is affected by the decision of the board. What does it mean? It means that we are required to make the computation of the market price of the equity share before before board of directors took the decision and say after the board of directors have taken decision. That is, in two scenarios, we are required to make the computation of the market price of the share. Dear students, we understand over here that the board of directors have already taken a decision. So you don't have to suggest that whether this decision is correct or not. You just have to evaluate the impact of this on the market price of the equity share. Also, that is the second question starts. The second part of the question that we'll read later on, we are ignoring that for the time being because we are focusing on the first question for the time being. And the cost of capital is provided to us as 8%. That is, the discounting factor is provided to us. Let us have understanding that how to make the calculation of this very simple answer. So, answer of question number 2b. In that we understand like this. Calculation of market price of equity share before accepting the new project. Now, before we accept the new project, what is the market price of the equity share? Let us see. In that, first of all, we'll make the calculation of D1. So it is D0 into 1 plus D. That is the way the D1 is calculated. What is the dividend paid? Just like right now, 2 rupees per share. What is the growth rate in dividend, dear students? Growth rate in dividend is 6%. So into 1.06. That comes to 2 rupee 12 paise. That is the way the D1 is calculated. Okay. Then calculation of P0. P0 is calculated as D1 divided by K minus C. What is D1? It is 2 rupee 12 paise divided by cost of equity minus growth rate. So we can see that the cost of capital is provided to us 8% and growth rate is 6%. So 0.08 less 0.06. So 2 rupee 12 paise divided by 0.02. With that, the price of equity share is calculated. That comes to 106. So P0 is rupees 106. That is the way the market price of the equity share can be calculated before we accept the project. Okay. Now again we are required to make the computation of the price of equity share after accepting the project. So new heading, calculation of market price of equity share after accepting the new project. Dear students, the question says that once we make investment in that new project, no dividend for the first 3 years. Fourth year dividend is going to be 2 rupee 50 which is going to grow at the rate of 7% per annum. Like that information is given. You can see that the question says like this. The board declared to take up a project by retaining next 3 years annual dividend. It will retain. It means that nothing will be distributed and nothing will be received by the investor. Growth rate will be 7% per annum. From which year? From fourth year. And dividend per share is 2 rupee 50. So here we'll make the calculation like this. Like basically, generally I suggest a sequence like this. Step number 1, calculation of dividend per share year 1 to year 4. So we understand that over here, first year, second year, third year, fourth year. Amount of dividend per share 0, 0, 0 and then 2 rupee 50. That is the way we'll compute first of all the dividend per share. Step number 2, calculation of P3. P3 stands for price of the equity share at the end of the third year. So it will be calculated as D4 divided by K minus T. Fourth year dividend is 2 rupee 50. Cost of equity is 8%. Growth rate is 7%. So this comes to rupees 250. In bracket I am writing over here. This is year 3 end. Dear students, we understand that P3 stands for price of the security at the end of the third year. At the same time, it means fourth year onwards for perpetuity, whatever dividend that investor is going to receive, all of them have been discounted to third year end. Then calculation of P0. Dear students, over here we understand that we are required to go with the cash flow series in this question. Why? Because for first 3 years the growth rate is 0 and then growth rate is 7% for perpetuity. Since there is a change in the growth rate later on, so we are required to go with the cash flow series instead of applying a simple formula. So 250 rupees, discounting at the rate of 8% and present value. .7938 is the discounting factor. So 250 into 0.7938. So it is 198.45. That is the way we can make the computation of P0, 198.45. This is what we understand is a P0. Now friends, instead of this 3 years, if at all we take 4 years, 5 years, any other number of years is acceptable. Usually we will take the time period by which the growth rate is becoming constant for perpetuity. That is over 3 years in this example, because after 3 years the growth rate is constant for perpetuity, that is 7%. Otherwise, if at all you prepare the cash flow series for 4 years or 5 years, and even for the 2 years the answer will be same. However, preparing a cash flow series less than 3 years, in that case the answer will become slightly complicated. So I do not suggest that. So first part of the question is over. We understand the first part of the question is like this. That is, for that the answer can be written like this. Over here, current market price of equity share, current market price of equity share, rupees 106, comma, will increase to rupees 198.45 by accepting the project. So soon after you make announcement that the project is accepted, the price of equity share increases theoretically to 198.45 from 106. Okay, now also advice. So from here onwards the second part of the question starts. How the investor can maintain his target receipt from the investment for the first 3 years and improved income thereafter. Information is provided. An investor is holding 1000 shares in SAM Limited and wants a receipt of at least 2000 rupees per annum from this investment. So we understand that the company suddenly made an announcement that said we are not going to make the payment of dividend. And information is provided to us that an investor requires an amount of rupees 2000 every year. Maybe a senior citizen, so he was depending upon the cash from this security in order to meet with his certain expenses. So 2000 rupees is required every year. However, the stock is not going to make payment of any dividend. So the only option which is left with the investor is to sell the investment. So we know that the price at the end of the third year is 250. If at all you sell one equity share at the end of the third year, you'll get 250 rupees. If you want 2000 rupees, then in that case, you are required to sell 8 number of shares. So I'm writing over here number of shares. It is 2000 divided by 250. That comes to 8 number of shares. Similarly, you will make the computation of the P1 and you will make the computation of the P2. Whatever may be the answer, we understand and say that 2000 rupees upon P1, again 2000 rupees upon P2, again 2000 rupees upon P3. So whatever the amount, 2000 divided by P1, P2 and P3, that will give us the number of shares that we should sell at the end of every year in order to get an amount of rupees 2000. So what will happen, dear students, let's say out of 1000 number of shares, this number of shares will be deducted by end of third year. Whatever is the remaining number of shares into 2 rupee 50 paise. Why? Because the fourth year dividend is 2 rupee 50 paise. That is the amount of dividend income in the fourth year, which will grow, which will increase at the rate of 7%. That is the way we are required to write the answer over here. Okay. It means, let's say, before we make the computation of the second part of the question, we are required to make the computation of the P1, yes. P2, yes. Those two prices are required to be calculated. Again, I am dictating a small note over here. This note is not forming part of the answer. That is only for your understanding purpose. Write an answer. Over here, information is provided that investor wants receipt of rupees 2000 per year. Full stop. Dividend income is 0 during first 3 years. Full stop. Hence, investor does not have any choice but to sell equity shares at the end of first year and second year. So in the first year and second year, investor does not have any choice but to sell the investment. So now answer of the question starts. Calculation of P1. P1 stands for price of equity share at the end of the first year. Okay. P1 means price of equity share at the end of first year. Okay. Let us see that say how to make the computation of answer. Dear students, we understand that say year 1, year 2, year 3. Amount of cash flow is 0, 0 and 250. Now this is what say we have used for the purpose of P0 calculation. Okay. Now the same thing will be used once again for the purpose of calculation of P1. So P1, price of the equity share at the end of the first year, means you are purchasing the security at the end of first year. So now the second year becomes the first year, third year becomes the second year. So the second year cash inflow will be discounted to the first year end, and third year cash inflow will be discounted again to the first year end, for the purpose of making calculation of the P1, because this time we are required to make the computation of the P1. So we understand like this, that first year and second year cash inflow dash and 250, it is discounted at the rate of 8%. That comes to 0.9259. Present value 250 into 0.9259, 231.48. That is the way we will compute the P1, 231.48. Now friends, we understand that say for the purpose of calculation of P1, if at all you are thinking that say can we apply the formula D2 divided by K minus C, then just giving a clarification that say application of this formula is say basically not possible. Why it is not possible? It is not possible because of the reason that the growth rate is not constant for perpetuity say at the end of the first year. That is the reason. So we cannot have application of say this formula. Application of this formula is say with the condition that the growth rate has to be constant for perpetuity at that particular point of time. That is at the end of the first year, which is not the case. Okay. One more clarification that I want to give. P0 is equal to D1 plus P1 divided by 1 plus K. So P1 is equal to P0 into 1 plus K minus D1. If at all you want to apply this formula, then yes, you can apply this formula for doing answer. What is P0? I think it is 198.45. That is what we understand is the P0 that we have. Yeah, 198.45. Into 1.08. Because we understand that say basically the investor requires a return at the rate of 8%. So 198.45 into 1.08. So the price of the equity share will increase to 214.33. And if at all any dividend is received by the investor, then it is deducted. Why? Because to the extent of the dividend income, return has already been received by the investor. So this 214.33 is what we understand is the P1. That is the way we can compute the answer. So over here you can see that the answer is okay. So over here the second year factor, I think that's it, 1.08. Friends, second year factor is 0.8573. So over here it is 8573. So it is 0.85, 250 into 0.8573. So it is 214.33. This is the way we can have a cross verification of the answer. Okay. Now after calculating P1, I am doing calculation of P2. P2 stands for price of equity share at the end of the second year. Let us see the calculation of the P2, the price of the equity share at the end of the second year. Dear students, it can be calculated like this. The way we have done the P0, in which year 0, 1, 2, 3, and the third year cash inflow was 250. Now we want to compute the P2, means you are going to buy the security at the end of the second year, and the second year becomes year 0. Third year becomes year 1. So the 250 becomes the third year cash flow, which is discounted to second year end, means it will be discounted with the first year factor, and it comes to 231.48. Or otherwise, we can make the computation of the answer in a different method also, wherein we can take the help of P1. We know that so the P1 is equal to D2 plus P2 divided by 1 plus K. Means price at the end of the second year, dividend income at the end of the second year, discounted to end of year 1. So what will happen? P1 into 1 plus K is equal to D2 plus P2. So P2 is equal to P1 into 1 plus K minus D2. What is P1, dear students? P1 is 214.33. So it is 214.33 into 1.08 once again. That is 231.48. Minus dividend at the end of the second year is a 0. So it is 231.48. That is the way we can make the calculation of the P2. Fine? Okay. As far as the P3 is concerned, value of the P3 we already have. So based on that, so we can make the computation of like the number of shares to be sold at the end of every year. So next is the calculation of number of equity shares to be sold at the end of year 1 to year 3, so that there is an annual receipt of rupees 2000. Okay, so now what will happen, dear students? First year, second year, third year, we will mention the number of shares. Number of shares will be like this: 2000 upon P1. Now what is P1? P1 is 214.33. So divided by 214.33. Then again 2000, dear students, divided by P2. Why? Because this is what's the number of shares to be sold at the end of second year. And here is P2, 231.48. Third year, it is 2000 divided by P3. Now what is the price at the end of the third year? It is 250. So 2000 divided by 250. So now we understand like this, that 2000 divided by 214.33, that comes to 9.33. So it comes to 9.33. 9.33 is very near to 10, so we are required to mention over here 10 shares, because we cannot sell like the fraction number of shares, and selling less number of shares, in that case you will not be able to get rupees 2000 as we desire. Next, 2000 divided by 231.48, and answer of that comes to 8.64. Now 8.64 is again near to 9. You cannot sell 8 number of shares, because in that case you will not get the desired amount. Then 2000 divided by 250, that comes to 8 shares. This is the way we are required to compute that how many shares are required to be sold at the end of each year, so as to get the target receipt of rupees 2000 each year. Okay, now I am calculating the dividend income for the fourth year. Calculation of dividend income of year 4. It is dividend per share of the fourth year into number of shares. Fourth year dividend per share is 2 rupee 50 paise. Multiplied with the number of shares are 1000 minus, we understand in the first year 10 shares, second year 9 shares, third year 8 shares. This is the number of shares that you have sold every year, 10 plus 9 plus 8. So it comes to 27 shares that has been sold out of 1000. So what happens that the dividend income is 2 rupee 50 paise per share. On this 973, number of shares. So 973 into 2.5, it comes to 2432.5. It comes to rupees 2432.50. Okay. Dear students, this amount is fairly exceeding rupees 2000. So from 4th year onwards, you don't have to sell the investment. And dear students, this amount is going to further increase at the rate of 7% per year. So of course, it is going to remain greater than rupees 2000 every year. So we'll write the final answer like this. Investor will get rupees 2432.5 in 4th year, and this will increase at the rate of 7% forever thereafter. This is what we understand. Okay. So just a small summary of the working that we have done. In the first part of the question, we had to make the computation of the price of the equity share before accepting the project and after accepting the project. So this is what we understand is the D1 calculation. Then based on that, the P0 calculation before accepting the project. After accepting the project, we have to prepare the cash flow series because there is a change in the growth rate. For the first 4 years, the dividend per share, in that first 3 years it is 0, and 4th year it is 2 rupee 50 as provided to us in example. Then P3 value, it is 250 rupees at the end of the 3rd year. That is 4th year onwards for perpetuity. Whatever income that investor is going to receive is discounted to the 3rd year end. Now based on that P0, 198.45. So the first part of the question is that the current market price of the equity share, which is 106, will increase to 198.45 by accepting the project. Next is like understanding, that's how we will compute answer of the second question, that we will sell certain number of shares every year in order to get an amount of rupees 2000. So we made the computation of the P1, that is price of equity share at the end of the first year. Then we made the computation of P2, price of equity share at the end of the second year. P3 already we have. So the amount that we require 2000 divided by P1, divided by P2, divided by P3. This is the number of shares that we will sell at the end of every year. And with that, say we understand we are left with 973 shares after liquidate of this number of shares. Dividend per share of the 4th year into number of shares will give the income for the 4th year, which will grow at the rate of 7% for perpetuity. This is what we understand. Okay. Proceeding for the next question. The next question is like this, that sustainable growth rate is important to enterprise long-term development. Explain this statement in the context of the planning healthy corporate growth. Answer of the question is here. Sustainable growth rate is important to the enterprise long-term development. Too fast, too slow growth will also go against the enterprise growth and development. So financial should play important role in the enterprise development. Adopt suitable financial policy initiative to make sure the enterprise growth speed close to the sustainable growth ratio and have sustainable healthy development. The sustainable growth rate of the firm is the maximum rate of the growth in the sales that can be achieved. Given the firm's profitability, asset utilization, desired dividend payout, debt financial leverage ratios. The sustainable growth rate is a measure of how much a firm can grow without borrowing more money. After the firm has passed this rate, it must borrow the funds from another source to facilitate the growth. Variables typically include net profit margin on new and existing revenue, asset turnover ratio, which is the ratio of the sales revenue to total assets, the asset to the beginning of the period, equity ratio, and the retention rate, which is defined as the fraction of the earning retained by the business. This is what's the earning that we retain, reinvest in the business. So sustainable growth rate, that is G is the growth rate, is 1 minus dividend payout ratio is called retention ratio into return on equity, that is R. So growth rate is simple B into R. Sustainable growth rate model assumes that the business wants to maintain a target capital structure without issuing new equity. So there is the constant capital structure. Maintain a target dividend payout ratio. So the dividend payout ratio is going to remain constant. Increase sales as rapidly as the market conditions allow. This is what we have. Question number 3A, next question. MK Limited is considering acquisition of NN Limited, and the following information is available. So information is given about the MK Limited and NN Limited. Earning after taxes, that is EAT, is provided to us. It is an amount of 60 lakhs, it is an amount of 18 lakhs. Number of equity shares are given. It is 12 lakhs and 3 lakhs. Market value per share is given, that is MPS is provided to us. It is 200 and 160. Exchange of equity shares for acquisition is based on the current market value as above. So we understand, let's say 160 divided by 200. That is the way we can determine the exchange ratio. So over here we understand that over here 160 upon 200, that comes to 0.8 share. At the same time, we can go logically like this. Logically, we can go like this. That number of equity shares of the target company are 3 lakhs. The price per share is 160. So we can say that its value is 480 lakhs. Okay. As far as the acquiring company is concerned, its market price of the share is 200. So 480 lakhs divided by 200. So in order to acquire the target company, 2,40,000 shares are required to be issued. How this 2,40,000 is calculated? It is 480 lakhs upon 200 rupees per share. So it is 2,40,000 shares. Okay. Now 2,40,000 shares against 3 lakh number of shares. So 240 divided by 3, it comes to 0.80. That is also the way 0.80 can be calculated. Okay. Now the question says that there is no synergy advantage available. Unfortunately, there is no synergy. Find earning per share EPS for the company MK Limited post merger. So EPS is required to be computed for the company MK Limited after the merger. And then the second part of the question is there. Second part of the question says, find the exchange ratio so that shareholders of NN Limited, that is target company, would not be at a loss. That is what we are required to compute. So let us go with the first part of the question. Very simple question, dear students, from the mergers and acquisitions chapter. It is answer of question number 3A that we are pursuing. So answer of question number 3A that we are pursuing. In that, answer of the first question, calculation of exchange ratio based on market price of the share. So it will be calculated as MPS of NN divided by MPS of MK Limited. Now, as far as the target company is concerned, its market price is 116 and acquiring company has a price of rupees 200. So the answer comes to 0.80, or it is 0.80 is to 1. This is the way you can have a simple answer, or otherwise you can write the answer logically also if you want to write. Then in that case you would do answer like this. Working note number 1, calculation of market value of NN Limited. It is market price of the share of NN Limited into number of shares. Okay, market price is 160 and number of shares are 3 lakhs. That comes to 480 lakhs. That is the way, first of all, we'll make the computation of the market value. Working note number 2, calculation of shares issued by MK Limited. We understand it is the share and amount. For every 1 share of MK Limited, the price is 200 rupees per share, dear students. So the logic is that, say, acquiring company has a contingent. That's say, you know that price of my equity share is 200. So when I issue my 1 equity share to you, it is deemed that consideration of rupees 200 is discharged. So for 480 lakhs, this is the consideration, that is, this is the number of shares to be issued. So we understand it is 480 lakhs into 1 does not make a sense, upon 200. So 480 lakhs divided by 200, that comes to 2,40,000 shares. Now issuing 2,40,000 number of shares against this 3 lakh number of shares, that will give us the exchange ratio. Exchange ratio or the swap ratio is indicating number of shares issued by the acquiring company for every 1 share of the target company. So exchange ratio formula is shares issued divided by number of shares of NN Limited. How many shares are issued? 2,40,000. And what is the number of shares that the NN Limited has? It is 3 lakhs. So what is exchange ratio? It is 0.80, or 0.80 is to 1. That is the way you can compute the answer by either of the method, whatever suits to you, whatever is comfortable to you. Now the question says that, say, compute the EPS. Okay. Now continuation with the first answer. Calculation of earning per share of MK post merger. We can also say it is the MPS of the merge firm, EPS of the merge firm. It is calculated like this. It is earning after taxes of MK plus earning after taxes of NN divided by number of shares of MK plus number of shares of NN multiplied with the exchange ratio. This is what we have. Earning after taxes, let us start with that. Earning after taxes is provided as 60 lakhs and 18 lakhs. So the numerator is 60 lakhs plus 18 lakhs divided by number of equity shares. Number of equity shares of acquiring companies provided to us as 12 lakhs. So this is 12 lakhs plus number of shares of the target company 3 lakhs, I think, yes. Into exchange ratio 0.80. So the numerator is 78 lakhs, dear students. Divided by 2,40,000 plus 12 lakhs, that is 14,40,000. That is the way the EPS of the merge firm can be computed. 78 lakhs upon 14,40,000. So it comes to 5.4167. 5.4167 rupees per equity share. Proceeding further. So the first question answer is, find out the EPS for the company MK Limited after the merger. That is what we have done. Now, second part of the question says that you are required to find exchange ratio, that is swap ratio, so that the shareholders of the target company would not be at a loss. That is the question. Okay. Now we understand like this, dear students, for the second part of the question. We can do answer by more than one method. Let us see how to write the answer. Calculation of minimum required exchange ratio by NN so that current EPS is not diluted after merger. Okay, let us see how to make the calculation of answer. Working note number 1, calculation of EPS of NN Limited. Dear students, over here you can see right now the earning is an amount of 18 lakhs, number of equity shares are 3 lakhs. That will give the EPS. So it is earning divided by number of equity shares. Earning is an amount of 18 lakhs. Number of equity shares are 3 lakhs. So earning per share is rupees 6. That is the way the EPS can be calculated. Okay. Then Working note number 2, calculation of exchange ratio. Let us understand how to make the computation of the exchange ratio. We understand like this: EPS attributable to NN is equal to EPS of merged firm multiplying with exchange ratio. This is the formula that we have. The EPS attributable to NN post merger should be same as it was before merger, that is 6. Now EPS of the merged firm, for that we understand it is earning after taxes of MK plus earning after taxes of NN divided by number of shares of MK plus number of shares of NN into exchange ratio. This is the formula for calculation of the EPS. However, importantly, we understand that for the target company, EPS of the merged firm into exchange ratio is EPS attributable to them. So over here, 6 rupees is equal to earning after taxes of MK is an amount of rupees 60 lakhs. NN, it is an amount of 18 lakhs. So the numerator is 60 lakhs plus 18 lakhs divided by number of equity shares. Number of equity shares are 12 lakhs plus 3 lakhs into exchange ratio. 12 lakh plus 3 lakhs into exchange ratio, whole into exchange ratio. That is the way we'll make the computation of the exchange ratio as balancing figure. So what will happen? 12 lakh plus 3 lakhs into exchange ratio is transferred on the left hand side. 12 lakhs plus 3 lakhs exchange ratio is equal to 60 lakhs plus 18 lakhs, that comes to 78 lakhs exchange ratio divided by 6. So 78 lakhs divided by 6. 78 lakhs divided by 6. That comes to 13 lakhs. So we understand it is 13 lakhs exchange ratio minus 3 lakhs exchange ratio is equal to 12 lakhs. Okay. So now 12 lakhs is equal to 13 minus 3, it comes to 10 lakhs exchange ratio. So exchange ratio is equal to 12 lakhs divided by 10 lakhs. So what will happen? It is 6 upon 5. This is what's the minimum exchange ratio which is required by the shareholders of NN Limited. This is the way you can compute the answer. At the same time, dear students, you can compute the answer with an alternative method. This answer can be computed by an alternative method. The alternative method is like this. In examination, you can write either of the method, alternative method. In that, working note number 1, calculation of EPS of both the companies before merger. One is MK Limited and another is NN Limited. Earning after taxes. Okay. Earning after taxes is 60 lakhs and 18 lakhs. This is an amount of 60 lakhs. This is an amount of 18 lakhs. Number of equity shares. For the first company, it is 12 lakhs. For the second one, it is 3 lakhs. This is 12 lakhs and this is 3 lakhs. Earning per share. For the first company, it is 5 and for the second company, it is 6. That is the way, first of all, what you can do, you can compute the EPS of each of the company before merger. So now we can make the calculation of answer like this. Exchange ratio is equal to earning per share of NN upon earning per share of MK. EPS of NN is what? 6 divided by 5. You will get the answer. This is also the way you can make the calculation of answer. Either of the way presenting the answer is acceptable in examination. Dear students, this is the formula, nothing else but it is the simplification of this logical formula. Whatever this logical formula that we have, its simplification is that formula. This is what we understand. Next, B part of the question, it is question number 3B. Let us proceed with that. Answer of question number 3B. Just one clarification, as far as the alternative method is concerned, it is possible to be applied only if there is no increase in the earning due to merger and we are required to compute the break-even exchange ratio. Remember that these two conditions are required to be satisfied. Only in that case you can go with the alternative method, otherwise we are required to go with the first method. So answer of question number 3B, that works out like this. Mr. Y has invested in 3 mutual funds as per the following details. So the information is provided about the 3 mutual fund scheme in which investor has made investment. So particulars X, Y and Z information have been given. Dear students, I am reading the particulars information and X mutual fund information. Rest 2 I am not reading because with that we will be able to understand the entire information. Amount of investment rupees 2 lakhs. NAV at the time of purchase, that is at the time of investment, 10 rupee 30 paise. Dividend received by 31st of March, an amount of rupees 6,000. NAV at the end of the period, 10 rupee 25 paise. The effective yield on per annum basis is given as on 31st of March in percentage term 9.66%. Assume 1 year is equal to 365 days. Thank you for giving this clarification. Mr. Y has unfortunately misplaced the documents of his investment. Help him in finding the date of his original investment after ascertaining the following. So there are 4 things that you are required to ascertain, you are required to identify, you are required to compute, and then you are required to help him to locate that, say what must be the date on which the investment is made. Okay. The first thing that you are required to compute is the number of units investment in each of the scheme. See, I am discussing about the X mutual fund properly. With that, you will understand that how to do answer for Y and Z. See, the amount of investment is 2 lakhs. Yes or no? Yes. NAV on entry date is 10.3. Yes. So I think that will give us the number of units that would be allotted to you on the date of investment. It is 19,417.48. So this is the number of units. Okay. The total net asset value. Okay. We already have the number of units allotted to us, 19,417.48 number of units, multiplying with. We can see that the information is given NAV 10 rupee 25 paise. So into 10 rupee 25 paise. So 19417.48 into 10 rupee 25 paise. So value of the investment, value of the units is 1,99,029.70. Fine? Yes. What is the total yield? That is a question. So friends, we understand that say the total yield is that you made investment of 2 lakhs. Yes. Value of the investment is falling down. So there is a loss. Yes, there is a loss. How much? 1,99,029.17 minus 2 lakhs. So there is a loss of 970.83. And there is a dividend income of rupees 6,000. So you add 6,000 to it. So it comes to 5,029.17. That is the way. So the yield can be, yield means a return that can be computed in order to compute the time period for which the investment was held by the investor. What we have to do, dear students, we are required to make the computation backward. See, usually we do the return calculation. How do we make the return calculation? It is yield, that is the income, divided by investment into 365 divided by n into 100. Now over here in this formula, you can see that say we have the return yield 9.66. So this one variable we have, yield we have over here 5029.17. Yes. Amount of investment we have 2 lakhs. 365 is a value and 100 is also a value. So n will be calculated as balancing figure. Once you compute the time period of holding investment, that time period will be subtracted from 31st of March and backward calculation will be made. To compute the last answer, that's what is the date of his original investment. So the fourth answer is the time period of holding investment, and then that number of days will be deducted from 31st of March to compute the date on which the investment is made. That is a simple way by which we are required to calculate the answer. Okay. So let us start with the working year, students, in which we'll compute first of all the number of units allotted to the investor, say for each of the scheme. Let us write an answer. Calculation of number of units allotted to investor. Let us compute the number of units allotted to the investor. It will be calculated like this: amount of investment divided by net asset value per unit. That is how we will compute the number of units allotted. It is the mutual fund scheme and units allotted. There are 3 mutual fund schemes that we have: X, Y and Z. Number of units allotted will be calculated like this. For X mutual fund, it is 2 lakh number of units and 10 rupee 30 paise is the value. 2 lakh rupees the amount divided by 10.30. Next, 4 lakh rupee is the amount divided by 10.10, that is 10. So 4 lakhs upon 10.10. And in case of the third mutual fund scheme, it is 2 lakh rupees is the amount divided by 10 rupees per unit. That is a way we'll make the computation of the units allotted. So 2 lakh divided by 10.3. So 19,417.48. In the next one, it is 4 lakhs upon 10.10. It comes to 39,603.96. In case of last, it is 2 lakh divided by 10, that comes to 20,000 number of units. This is the way we'll compute the number of units. Next question. The question says that calculate the total net asset value. So second question, calculation of total NAV. So in that case, again mutual fund column, first, second and third, then net asset value. So 19,417.48 into NAV per unit. What is NAV per unit? It is 10.25. So this is 10.25 for the first mutual fund. For second one, it is 39,603.96 into, again NAV per unit is 10. In the last case, it is 20,000 number of units multiplied with NAV per unit, which is given to us as 10 rupee 20 paise. So this is 10 rupee 20 paise. That is the way we will make the calculation of answer. So for mutual fund X, 19,417.48 into 10.25. That comes to 1,99,029.17. For the second one, it is very simple. It is 3,96,039.60. And for the last one also, it is very simple. 20,000 into 10.20, that comes to 2,04,000. So it is 199,029.17 plus 3,96,039.6 plus 2,04,000. So the total NAV is 7,99,068.77. That is on 31st of March. This is the total NAV. Next question, total yield. So third question in that, calculation of total yield. Let us see how to make the calculation. Column number 1 is mutual fund. Column number 2 is dividend income to the investor. Dividend income from the mutual fund scheme. Then NAV1 minus NAV0. That is change in the NAV. And based on that, so we can compute the total yield. Okay. So now, as far as the mutual fund X is concerned, the amount of dividend income is 6,000, 0 and 5,000. So it is 6,000, then 0, then it is 5,000. That is the way we can compute the dividend income. Then NAV1. Okay, what is NAV1? It is 1,99,029.17. 1,99,000 29.17 minus 2 lakhs. That comes to 970.83 negative. 6,000 was income, so 5029.17. For the first scheme. For the second one, it is 396,039.6. Minus 4 lakhs. So 396,039.6 minus 4 lakhs. That comes to negative 3960.6. 60.40, sorry. No dividend income, so that is loss 3960.40. In last case, it is 2,04,000 year students. So NAV1 2,04,000 minus NAV0, that is the amount of investment, again 2 lakhs. So this time investor is lucky to get appreciation in the units value by rupees 4,000. 4 plus 5, total income is rupees 9,000. Okay, so 5029.17 plus 9,000 minus 3960.40. So the total yield is 10,068.77. This is the way, so the total yield is calculated. I repeat that again, that first of all the dividend income 6,000, then NAV1 minus NAV0, that is so the change in the units value, and total of both of them is the total yield. Accordingly, so it comes to 10,068.77. This is the way the yield is calculated. Next, number of days for which the investment is held, and I think that this is quite good question that we have. So the fourth question, in a simple language, time period of holding investment. Let us see, let's say, how to make the computation of answer. Return is equal to income upon investment into 365 divided by n into 100. This is the way we'll apply the formula. Basically, we are required to compute the time period of holding investment. Yes. So n is calculated like this, that income upon investment into 365 divided by return multiplied with 100. Now, first of all, let us see how to make the computation for X. Dear students, for X, the income has already been found by us, 5029.17. It is positive 5029.17 divided by investment is taking an amount of 2 lakhs. 365 is a number only. Return, that is the effective yield, has been provided to us that is 9.66 percentage. So it is 9.66 multiplied with 100. That is the way, so the time period of holding mutual fund X can be calculated. So 5029.17 multiplied by 365 multiplied with 100 divided by 2 lakhs divided by 9.66. So the answer comes to 95.01. So we can write 95 days. That is the way we will make the computation of the answer of time period of holding investment. We will do the similar working for Y mutual fund scheme, wherein the formula is going to remain same. First of all, income. Income is unfortunately negative 3960.4. So the same equation which we already have mentioned, 3960.4 divided by investment is 4 lakhs, because in case of mutual fund Y, the investment that we have made is 4 lakhs, into 365 divided by return. And what is return, friends? It is 11.66% negative. So it is negative 11.66 into 100. So dear students, we can of course understand that so this negative will become positive. So 3960.4 multiplied by 365 multiplied with 100 divided by 4 lakhs divided by 11.66, and it comes to 30.99. So can we write 31 days, dear students? That is for Y mutual fund scheme. Similarly for Z mutual fund scheme. What is the yield? Yield is 9,000. That is income. Upon investment is 2 lakhs. Into 365, yes. Divided by the time period of holding, divided by return. Return is huge, 24.15. Even I would like to make investment in such mutual fund scheme. Multiplied with 100. So it is 9,000 into 365 into 100 divided by 2 lakhs divided by 24.25. That comes to 68.01. So it is very near to 68. So it is 68 number of days. Okay. So this is the way we will make the computation of the time period of holding investment, which is now completed. Now the last answer is, because the question says that say after making all this, ascertain the date of investment. So the last answer is calculation of date of investment. In that I am writing first of all mutual fund X. Now dear students, you can see that the time period of holding investment is provided to us as 95 days. So we are required to do the backward calculation, and with that we will compute that say what must be the date on which the investment must have been made. So now we understand like this. Column number 1 is month, second is the days, then cumulative days. We have to go backwards, so March 31 days, cumulative it is 31 days. Then February it is 28 number of days, so it is 59. That is 31 plus 28. Then you go back for the January month, in that it is 31 days again, so it is 59 plus 31, that comes to 90 days. Then 5 days for the month of December will be deducted in order to compute the date of investment. So 31 minus 5, it comes to 26th of December. That is the date on which the investment must have been made. So over here, as far as the first mutual fund scheme is concerned, we understand that investment must have been made on 26th of December 2017. Okay. Then mutual fund scheme Y. In that, the time period of holding investment is exactly 31 days. So in that case, it is very simple once again. Date of investment is 28th of February 2018. That must be the date. Only 31 days of the March month is required to be deducted. Then Z mutual fund scheme, in that month, days, cumulative days. March 31, cumulative is 31. Then February, it is 28, it is 59. Then January month, okay, in January month it is like the investment must have been made, so 68 minus 59, that comes to 9 number of days. So 9 will be deducted from 31. So it comes to 22nd of January. 22nd of January, it is 31 minus difference of 68 and 59. 22nd of January, date of investment. This is the way we have to find answer. So this is the way we are required to complete this. I would say relatively a very simple question. See, there are a number of calculations which are required to be made. I do not say no for it. However, I would say that the question is quite simple and it is similar to the kind of working that we already have done for similar to this question. Because similar to this question, say, have been provided by institute in the practice manual also. And whenever this, that is the point at which this question was asked in examination, I think that it was asked in the year 2018, there is only twist of the question. Usually the question was like this, that say you had to make the computation of the return from the given information. The time period, amount of investment, dividend, change in NAV, everything given. Then you have to compute the return. This time, based on the return, you have to find the time period of holding investment. So, number of units allotted, total NAV, total yield, time period of holding investment, and lastly, the date of making investment. This is what we are required to do. One more thing that I would like to tell to all of you over here is that the question is clearly providing that say take 365 days in a year. So there is no ambiguity say regarding taking number of months or number of days. Because in the similar question, we had an issue that in order to compute the return, sometimes institute is taking the number of days, sometimes institute is taking say the number of months. However, over here, clearly it has been provided that say you are required to take 1 year is equal to 365 days. So accordingly, we are required to make the calculation of answer. Next thing which I feel is like just for a kind of discussion that I want to make, dear students, is that so this is a very good question in which we have been provided with the progressive questions. The questions are provided progressively in such a way so that it leads to the final answer. There is no issue that we have, because sometimes before we compute the final answer, it may happen that certain things that you have to think on our own, and accordingly we are required to make the computation of the answer. However, in this question directly we have been provided with the information in terms of the questions. So whatever the things that we require at last, that we automatically calculate in the earlier part of the question. This is what we have. Next question. Explain various asset allocation strategies? That is a question. There are 4 asset allocation strategies. The first is integrated asset allocation. Second is strategic asset allocation. Third is tactical asset allocation. Fourth is insured asset allocation. These are the 4 methods that we have. The first one is integrated asset allocation. Under this strategy, capital market condition and the investor objective and the constraints are examined, and asset allocation that best serves investors' needs while incorporating the capital market forecast is determined. Strategic asset allocation. Under this strategy, optimal portfolio mixes based on the return risk covariances is generated using the historical information and adjusted periodically to restore target allocation within the context of the investor's objective and constraints. Tactical asset allocation. Under this strategy, investors' risk tolerance is assumed constant and the asset allocation is changed based on the expectation about the capital market condition. Insured asset allocation. Under this strategy, risk exposure for changing portfolio value wealth is adjusted. More value means more ability to take risk. That is the way we have the different methods. Question number 4. A. Mr. Ram purchases 10,000 equity shares of X Limited at the price of 22 rupees per share, whose beta value is 1.50. So dear students, we have been provided with a specific transaction. I am writing the transaction over here. I am not doing anything else. So, answer of question number 4A. That is what we are writing in that. Security X transaction, long position in cash market. So basically over here, say for the security X, the transaction is entered upon to buy the security and means another transaction. Sales 5,000 shares of A Limited at a price of 40 rupees having a beta value of 2. So another transaction is entered upon for security A. In that we understand short position in cash market. Short position in cash market. He obtains a complete hedge by Nifty futures at the rate of rupees 1,000 each. He closes out his position at the closing price of the next day. So the third is, I am writing over here security / Nifty. In Nifty, there is a transaction which has been entered upon for the purpose of the complete hedging, like that information is given. And on the very next day, he closes out his position at the closing price of the next day, when the share of X Limited dropped by 2%. So information is provided to us that on the very next day what happened, that the price of the security X decreases by 2%. Share of A Limited appreciated by 3%. Share of A Limited price increases next day. And the Nifty futures dropped by 1.5%. And Nifty future again dropped by 1.5%. The question says that interpret the overall profit or loss of Mr. Ram. So with this, you are required to give answer that what is the overall profit or overall loss to Mr. Ram. Okay, now what is the sequence in which you have to do answer? Let us have understanding of the same. Students are requested to pay attention. See, security X, security A and Nifty. There are three things in which the transaction is entered upon. A common sense, nothing is great in that to understand that say you are required to make a comparison of the sale value and purchase value for the purpose of profit or loss calculation. Simple sale purchase you have to compare. As far as security X is concerned, in that you have long position, it means that you have entered into the transaction to buy. What is the price? 22. And what is the number of shares? 10,000. So we understand that there are 10,000 shares which have been purchased at the rate of 22. So 2,20,000 rupees is the amount for which you have entered into the transaction for purchase. It has been given that the next day price of X Limited dropped by 2%. So sale value is going to be, friends, 2,20,000 minus 2%, that comes to 2,15,600. So 2,15,600 minus 2,20,000. So the difference of that is the profit or loss. What is profit or loss? So there is a loss. How much? 4,400. Okay. It is 2,15,600 minus 2,20,000. That comes to 4,400. That is the loss. For security A, the transaction has been entered upon as short position. Okay. What is the short position? That selling 5,000 equity shares at the rate of 40 rupees per share. So over here I am writing that's the sale value. 5,000 equity shares have been sold. The price is 14. So you already have entered into the short position by rupees 2 lakhs. Price of A Limited, we can see that it has been given. It increases by 3%. So what will happen over here? In purchase value we will write 2 lakhs plus 3%. That comes to 2,06,000. So unfortunately there is again a loss by 6,000 rupees. Now yet the answer is not complete, dear students. Why? Because the question is clearly providing the information that some transaction has been entered upon in Nifty. Like that information is given. So whether you have entered into the transaction to buy Nifty or you entered into the transaction for sale Nifty, that kind of clarification is made to us in the question indirectly. So what happens that over here, whether the purchase transaction is to be entered upon or sale is what we have to understand based on these transaction information. Let us understand and say how we are required to identify the same. Now to decide that and to calculate that, say we have to go with the logical process. What is that logical process? Let us understand. Students are requested to pay attention over here. See, basically you are required to see the transaction in which you have entered upon. You have entered into the transaction for long position in the cash market. Means you have entered into the transaction to buy. Now once you have entered into the transaction to buy, then you will incur a loss if at all the price is falling down. So in order to hedge your market exposure, what you will do, you will enter into the transaction for sale index. You have long position in the cash market, yes. So if at all the price is going up, you are happy, yes. When the price is falling down, in that case you have a loss, yes. How to cover up that loss? For that, say you should sell index. What is the value for which you should sell index? It is value of your portfolio, that is over here 2,20,000 multiplied with the beta. So what is the sale index? 2,20,000 into the beta is provided to us as 1.5. So into 1.50. So you have to sell index for rupees 3,30,000. Okay. Now the other one for security A, you have entered into the short position. If at all the price is falling down, you will be happy. If the price is going up, then in that case you will incur a loss. To cover up that loss, what you have to do, dear students, you are required to purchase index. The amount for which the sale transaction has been entered upon is 2 lakhs. So you have to buy index for rupees 2 lakhs. Multiplied with the beta, that is 2. That comes to an amount of rupees 4 lakhs. So there are 2 transactions in which you have to enter upon. Now there are 2 opposite transactions which are required to be entered upon. One is sale index, another is buy index. Now we know that nothing is free, everything is chargeable. So if at all you are entering into the Nifty transaction, then in that case you are required to make the payment of the transaction cost. So entering into the 2 opposite transactions at one point of time is not making a sense. So what we will do, friends, we'll make the net value. 4 lakh minus 3,30,000. That comes to 70,000. Purchase is more or sale is more? Purchase is more. So we understand that, say, purchase index of 70,000. The lot size is also provided 1,000. So 70,000 is in multiple of 1,000, so there is no problem. We can mention over here 70,000. That is against purchase variety. Now what happens to the Nifty on the very next day? It has been provided that, say, on the very next day, Nifty also dropped by 1.5%. So over here it is 70,000 minus 1.5%. It dropped. 70,000 minus 1.5%. 68950. Minus 70,000. It comes to 1050. So there is a loss in case of Nifty 2. Coincidentally, in all the 3 transactions, the trader is having a loss. In case of security X, security A, and also in Nifty. So overall, there is a loss of total of all this. Overall loss is 4,400 plus 6,000 plus 1,050. It comes to 11,450. That is the loss that we have, say, with this transactions. So we can observe that, say, there is a loss of 11,450. Now dear students, I am not discussing the concept over here because the concept is very deep. So I am not discussing the concept, I am discussing this question wherein you have been provided with a specific transaction along with the hedging, and you have been asked that say you compute the profit or loss next day. That is what the question is. Let us see the next question. B part of the question. ACCA Limited's current financial year's income statement reported its net income after taxes as rupees 50 crore. Following is the capital structure of ACCA Limited at the end of the current financial year. Debt financing of 80 crore, wherein the rate of interest is 11%. Equity share capital, that is equity, is 250 crore, that is consisting of the equity share capital and reserves and surplus. So the invested capital or capital employed is 330 crore. Following data is given to estimate KE, cost of equity. Asset beta is 1.11. Risk-free rate of return is 8.5%. Average market risk premium is given as 9%. The applicable corporate income tax rate is 30%. Estimate EVA, economic value added, of RST Limited, and the figures are in lakhs of rupees. In lakhs of rupees. That is what the question is. That is what we are required to find over here. Let us understand how to do answer of question number 4B. So answer of question number 4B. How to make the computation of the answer? Let us discuss that. The question says that you are required to make the computation of the economic value added, EVA. It can be computed by more than one method. I am discussing, say, the easier method with you. Dear students, we understand that the EVA will be calculated by using the simple formula NOPAT. It is net operating profit after taxes minus capital employed into weighted average cost of capital. This is a simple formula that we are required to apply. Now NOPAT is calculated as earning before interest and taxes into 1 minus T, that is NOPAT, minus capital employed, which is given to us in the question as 330 crore, multiplied with the weighted average cost of capital. This is the simple formula which we are required to apply for the purpose of doing the answer. Okay. Now you can see that there are certain things that we need to obtain over here, because income tax rate is given to us as 30%. However, EBIT is required to be calculated. We understand that the weighted average cost of capital is required to be computed. For weighted average cost of capital, we have to find cost of debt financing. We are required to find cost of equity financing. For cost of equity financing calculation, we are required to find the beta of the levered equity. That is the simple process by which we are required to make the computation of answer. So let us start one by one with the process. So step number 1, I am starting, dear students, calculation of weighted average cost of capital. That is the step with which we are going to start. In that working note number 1, calculation of beta of levered equity. That is the first thing that we are going to do. We understand that the beta of unlevered equity is equal to beta of levered equity divided by 1 plus debt into 1 minus T divided by equity. This is the simple formula which we are required to apply for calculation of the beta of unlevered equity. However, we have to find over here beta of levered equity. We just have to modify the formula to compute the beta of the levered equity, because we can see that the information is provided to us as the asset beta of the company. Asset beta stands for beta of unlevered equity, that is provided to us as 1.11. So I am rewriting the entire formula in terms of the beta of the levered equity is equal to beta of unlevered equity multiplying with 1 plus debt into 1 minus T divided by equity. That is the way the answer can be calculated. Okay. Now what is beta of unlevered equity? It is 1.11. So this is 1.11. Okay. Multiplying with 1 plus the debt financing is 80 out of 330. So 80 divided by 330. So it comes to 0.2424. So here it is 0.2424. Into 1 minus income tax rate. Income tax rate is given to us as 30%. So 1 minus 0.30 divided by equity. Equity would be balancing figure. 1 minus 0.2424, that is 0.7576. Now we will compute this, and this is what we understand is the beta of the levered equity. The concept says like this, that say when there is no debt financing, then in that case the beta of the equity is this much. However, since the debt financing is raised, so the expectation of the equity shareholder increases, and how much it will increase is what we understand is the beta of the levered equity. So 1 minus 0.3 is 0.7. 0.7 into 0.2424. So that is the way the numerator is 0.1697. So 0.1697 divided by 0.7576. This answer is added to 1 whole into 1.11 in order to make the computation of the beta of the levered equity. So 0.1697 divided by 0.7576. So the right hand side components comes to 0.2240. So 1.11 into 1.2240. Okay, so 1.224 into 1.11. So it comes to 1.3586. 1.3586. This is the way beta of the levered equity will be calculated. Once you compute the beta of the levered equity, after that, calculation of cost of equity. That is the next working that we are required to do. That is working note number 2. Calculation of cost of equity. It is RF plus beta into RM minus RF. This is a simple formula which we are required to apply. What is the risk-free rate of return provided to us in example? Risk-free rate of return is given to us as 8.5%. So this is 8.5 plus beta of the levered equity is 1.3586. into RM minus RF. What is RM minus RF? It is 9. So this is 9. So 8.5 plus 1.3586 into 9. That comes to 12.23. So 8.5 plus 12.23. It is 20.73. This is the way the cost of equity will be calculated. Working note number 3. In step number 1 only, all these things are going on. Calculation of KD, cost of debt financing. We can see that the information is provided to us that rate of interest is 11% and income tax rate is 30%. So over here, KD will be calculated as rate of interest into 1 minus D. So it is 11% into 1 minus 0.30. So it is 11% into 0.7. That is the way the KD will be calculated. So the answer comes to 7.7%. Okay. Now the last working. Calculation of weighted average cost of capital or overall cost of capital. Let us see, let's say, how to make the calculation of answer. Column number 1 is source of finance. Column number 2 is amount. Third column is weight, that is a proportion, multiplied with the cost of capital. Weight into cost of capital, that is the way the weighted average or overall cost of capital will be calculated. There are two sources of finance, debt financing and equity financing. So it is the debt financing, in that amount is 80 crore. The weight will be calculated as 80 divided by 330. So 80 divided by 330, 0.2424. Multiplied with the cost of debt financing is 7.7%. So it is 0.2424 into 7.7. That comes to 1.87. Okay. The remaining is the equity financing. Amount of equity financing is 250. So the weight of equity financing is 250 divided by 330. That comes to 0.7576. Multiplying with the cost of equity, which we have found over here, it is 20.73. So it is 20.73. So now 0.7576 multiplied with 20.73, that is 15.71. So 1.87 plus 15.71, it comes to 17.58. That is the way weighted average or overall cost of capital can be calculated. So the weighted average or overall cost of capital is 17.58%. Dear students, this is going to be useful to us for calculation of the economic value added. So coming back to the original point, I explained you that, say, we have the capital employed information. We have computed the weighted average cost of capital. Of course, we have the income tax rate information. So now EBIT is required to be calculated. So dear students, step number 2 will be calculation of the EBIT. Please write an answer along with me if at all you are writing answer. Step number 2, calculation of operating income, earning before interest and taxes. Let us see how to make the calculation of answer. We understand that the EBIT less interest. Interest is subtracted from the EBIT, so we get earning before taxes minus income tax. That will give us earning after taxes. Okay. We can see that the information is provided to us that income tax rate is 30%. So the tax rate is 30%. And earning after taxes is 70%. We have been provided with information like this, that net income after taxes is 5050 crore. So over here, the earning after taxes is provided to us as 50 crore. So the earning before taxes would be 50 divided by 0.7. That comes to 71.4286. This is 71.4286. That is 50 crore divided by 1 minus 0.3 or 50 crore divided by 0.7. Like that also you can write. The amount of debt financing that is provided to us is 80 crore and the rate of interest is 11%. So the amount of interest is 80 crore and the rate of interest is 11%. That comes to 8.8 crore. Okay. So the operating income is 8.8 plus 71.4286. That comes to 80.8826. 80.8826. This is the amount of the EBIT that we have. There is no need. Yet I am calculating the amount of income tax and it is 21.4286. That is 71.4286 into 30%. With that, you will calculate that. That is, you will be able to get the value. Okay, so step number 2 is calculation of EBIT, and then finally you will have the EVA, economic value added, as the final answer. We understand it is NOPAT, net operating profit after taxes, minus capital employed into weighted average cost of capital. This is what we understand. How to compute the NOPAT? It is earning before interest and taxes into 1 minus C minus capital employed into weighted average cost of capital. Now what is EBIT, dear students? EBIT is this 80.2286 crore. So the operating income is 80.2286 crore. Into 1 minus income tax rate 30% minus capital employed. Income tax rate is 30%. Capital employed is 330 crore. So it is 330 crore into weighted average cost of capital. That is 17.58%. 17.58%. So 80.2286 into 0.7, that comes to 56.16 crore or 5616 lakhs that we can write, because the question specifically provides that you are required to compute that into lakhs. 330 crore into 17.58%, that comes to 5801.4 lakhs. 5801.4 lakhs. it means that say we are not able to earn sufficient as what we should be able to earn, and that is the reason so the economic value added is negative. It is negative by 185.4 lakhs. So negative 185.4 lakhs. That is the EVA. Now dear students, we can compute this economic value added value by an alternative method also. For that, you are required to make the computation till the point this cost of equity. This is required to be computed. Afterwards, friends, we are required to make the computation of the economic value added like this. Economic value added is equal to basically earning available to equity shareholders, which is earning after taxes in this example. Why? Because there is no preferential capital, minus equity into cost of equity. Basically, we understand that say the company is making payment of the equity dividend equal to the cost of equity. After making payment of the dividend equal to the cost of equity, whatever the amount which is left with the company is what we understand is the economic value of it. The amount of the equity financing is given to us in the question is 250 crore. Multiplied with the cost of equity is 20.73%. So into 20.73%. With that, so we can compute the answer. So it is 5,000 lakhs minus 250 into 20.73. So it comes to 5182.5 lakhs. So in that case, it comes to negative 182.5. There is a marginal difference in the answer. It is only due to the approximation. Otherwise, exactly it is going to be the same. Either of the way, you may present the answer and you will be given full marks. That is the way we can compute the answer for the economic value added. Next question is, let us see the next question. C question. TRC Cables Limited, it is an Indian company, is in the business of manufacturing of electrical cables and data cables, including fiber optics cables. While mainly it exports the manufactured cables to other countries, it has also established its production facilities at some African countries. Due to availability of the raw material and importantly, there is a cheap labor. Some of the major raw material such as copper, aluminum and other non-ferrous material are also imported from foreign countries. Hence, overall TRC has frequent receipt and expenditure items denominated in non-rupee currency. Though TRC make use of long-term debt and equity to meet long-term fund requirement, but to finance its operation, it make use of the short-term financial instrument such as commercial paper, bank credit, term loan from the bank, etc. If any surplus cash is left with the TRC, it is invested in interest yielding securities. Recently, due to stiff competition from the competitors, TRC has relaxed its policy for granting credit, and to manage the receivable, it has formed a separate credit division. Further, to hedge itself against the various risks, it has entered into various over-the-counter OTC derivative contracts settled outside the exchange. You are required to evaluate the major risk to which TRC is exposed to. So, taking into account this business structure, we are required to identify the kind of risk to which the company is exposed to. The answer is like this. Following are the main categories of the risk to which TRC cable is exposed to. The first is financial risk. TRC is exposed to following financial risk. In that, the first one is the currency risk. Since most of the receipt and payments of the TRC are denominated in non-rupees countries, it is exposed to currency risk. Second is commodity risk. As major constitutes of the production of TRC, that is, are commodities such as copper, aluminum, etc., it is subject to commodity risk. The third is interest rate risk. As TRC borrows and invests money in short-term instrument, it is exposed to interest rate risk. Counterparty risk. Due to relaxation of the norms for granting credit, certainly the receivables amount have increased. Next is liquidity risk. Since the short-term funding requirement of TRC is using commercial paper, etc., they are exposed to liquidity risk. As in time of the need, if funds are not available from these sources, then the securities should be sold at a discounted price. The next is the political risk. As TRC is operating in the various other countries, it is also exposed to political risk such as restriction on the conversion of the local earning into foreign currency, restrictions on the remittance, etc. The next is the settlement risk. The use of the OTC derivative by TRC also expose it to the settlement risk, as the parties with whom it has entered into contract may not honor the same. Dear students, we understand that the OTC derivative or OTC the transaction are the transactions which are entered upon through over the counter. It means that we understand it is not through any standardized agency. So in that case, it may happen the situation in which you are making a profit. It means that you are required to take the payoff from the opposite party. In that case, the opposite party may default. That is the kind of risk which you have. Next, question number 5A. Mr. A high net worth individual, HNI, invested on April 1st, 2014 in certain equity shares as below. Name of the company X, name of the company Y. Cost is provided to us and number of shares have been given to us. For each of them, the cost is given and the number of shares are given. In September 2014, that is during the year, 10% dividend was paid out by X Limited, and in October 2014, 30% dividend was paid out by Y Limited. So the rate of dividend is given. So 100 rupees into 10%, that is 10 rupees is the dividend, and 10 rupees into 30%, 3 rupees is the dividend. At the end of the year, 31st of March 2015, the market quotation showed a value of rupees 220 and 290 per share for X Limited and Y Limited respectively. So the price of the equity share is provided to us on 31st of March 2015. On the very next day, that is on 1st of April 2015, a technical analyst indicated as follows. First, that the probabilities of the dividend from X Limited and Y Limited for the subsequent year 2015-16 is provided to us. We have been provided with the information about the probability, we have been provided with the information about the rate of dividend from X Limited and dividend provided from Y Limited. Face value is given, that is of course going to remain same, into rate of dividend will give the dividend per share. That the probabilities of the market quotation on 31st of March 2016 are as follows. So again we have been provided with the probability distribution of the price for X Limited is given and for Y Limited it has been given. You are required to analyze the average return from the portfolio for the year ended 31st of March 2015. So during 2015, what is the average return of the portfolio? That is a question. And so on, we have been provided with the second and the third question. So dear students, over here, we are required to make the computation of the, what is the return of the portfolio. We understand that from the given information, 2 crore is invested in X Limited and 1.5 crore is invested in Y Limited. So we can say that it is 3.5 crore is the investment that you have made. Further we understand that say the price at which the equity share must have been purchased is 200, because 200 lakhs divided by 1 lakh. So 200 rupees is the price at which the security has been purchased. And 150 lakhs divided by 50,000. So in that case 300 rupees must be the price at which the security must have been purchased. That is a way, so we can compute the price. Like I am discussing this orally with you, we'll write the answer also properly. So we have been provided that say what is the price at which the security has been purchased. We have been provided with the information about the dividend. We have been provided with the information about the return, that is so the price of the equity share at the end of the year. So what that is what we can compute. We can compute that what is the return of the security X, what is the return of the security Y. We already know that say what is the proportion in which the investment is made. We can say that say the 200 out of 315, so that will give us a proportion. 150 divided by 350, that will again give us some proportion. So that proportion into the return, with that say we'll make the computation that what is the return. And afterwards we are required to find the weighted average return say from the given information. So answer of question number 5A. Let us see that's how to make the computation of answer. Heading write down, that is say heading write down if at all you are writing answer with me. Calculation of RP, return of the portfolio. In bracket I am writing year 2014/15. That is the year for which, yes, year 2014-15 is the year for which you are required to find the answer. First of all, I am doing it for security X. In that, working note number 1, calculation of purchase price of the security. Okay, we understand that say it is the investment divided by number of shares. We can see that so the investment is made for an amount of rupees 200 lakhs and number of shares are 1 lakh. So the price at which the security has been purchased is 200. Okay. That is the way, so the first working note will be prepared, that is the price at which the security is purchased. Then working note number 2, calculation of dividend per share. That will be computed as the face value into rate of dividend. We have been provided with the information that the face value of equity share is here rupees 100 and the rate of dividend is provided to us as 10%. So we understand that it is 100 into rate of dividend is 10%. So it comes to rupees 10 per share. Okay. Then calculation of return. Return will be calculated, dear students, as D1 plus P1 minus P0 divided by P0 into 100. Now what is the amount of dividend? We have calculated that the amount of dividend is rupees 10 plus P1. Now what is the price of equity share at the end of the year? We can see it is 220. So it is 220 minus 200 divided by 200 into 100 for getting answer in percentage term. So 10 plus 20 divided by 200 into 100 for getting answer in percentage term, and it comes to 15%, dear students. This is the return of the security X. Now writing heading once again, security Y. We'll do answer in the same sequence. First of all, working note number 1, calculation of return. It will be computed as, calculation of the price at which the security was purchased. Price at which security was purchased. It is amount of investment divided by number of shares. Amount of investment is 150 lakhs and number of equity shares are 50,000. Yes, 50,000 is the number of shares, and the amount of investment that you have made is 150 lakhs. So in that case the price is yes 300 rupees per share. On a safer side, I just make the calculation so there is no error as such. 300 rupees per share. Working note number 2, calculation of dividend per share. It is face value of equity share multiplying with rate of dividend. That is measured in the percentage term. We have been provided that the rate of dividend is 30%. So in that case, face value of equity share, which is given to us as 10 rupees into 30%, so it comes to 3 rupees per share. So rupees 3 per share. And then computation of the return, that is calculation of return. As far as the return calculation is concerned, it is D1 plus P1 minus P0 divided by P0 into 100. Dear students, the price of equity share at the end of the year is given to us as 290. So, dividend per share is 3 plus 290 minus 300 whole divided by 300 into 100 for getting answer in percentage term. So 3 rupees is the dividend. However, the price of the security falls by rupees 10. So ultimately there is a loss of rupees 7 divided by 300 into 100. So in that case the answer is negative 2.33%. Once we compute the return of the individual security, then return of the portfolio will be calculated. Now friends, after making the calculation of the return from the individual security, we will make the calculation of the return of the portfolio, which is simple weighted average. So return answer, calculation of return of portfolio. Dear students, we will take into account the proportion in which we had the investment at the beginning of the period to compute the weighted average. There are two securities in which investment is made, security X and security Y. Amount of investment that we have made is 200 lakhs and 150 lakhs. So the total investment is made of 350 lakhs. Then we will calculate the weight / proportion. We understand that it is 200 upon 350. It comes to 0.5714. You may take up to even 2 decimals, that is also fine. And the remaining is the security Y. So it comes to 0.4286. Multiplying with the respective return. In the first case, the return is 15% as we have calculated, dear students. And in the second case, it is negative 2.33. So weight into return. So 0.5714 multiplying with 15. That comes to 8.571, or we can write 8.57. In the second case, it is 0.4286 into 2.33, which is negative. So it is 0.9986, or we can take minus 1. So the overall it comes to, of course, 7.57. That is what we understand is the return on the portfolio which you have been able to generate during the entire year. So the return of the portfolio is simple weighted average, taking into account the proportion in which we have raised the funds, that is, say we have made investment, multiplying with the respective return which we have computed, and with that, so the weighted average answer is calculated. Let us see the next question. The question says that, say, analyze expected average return from the portfolio for the year 2015-16. So similarly, we are required to make the computation of the return of the portfolio for the subsequent year. Let us see that, say, how to make the calculation of answer. So write down new heading if at all you are writing answer with me. Calculation of return of portfolio in bracket I am writing year 2015, year 2016. That is what we are required to find. In that, again I am starting with the security X. So over here we will prepare the working notes like this. We have been provided with the information about the probability for the dividend. So we can make the computation of the expected dividend. So for security X, working note number 1, calculation of expected dividend per share at the end of first year, that is at the end of the year 2016. Probability dividend per share, probability into dividend per share. Dear students, the probability is given to us 2, 3 and 5. So over here it is 2, 3 and 5. Rate of dividend is given to us 10%, 15% and 20%. So over here 100 rupees is the face value, yes, into rate of dividend. So 100 rupees is the face value into rate of dividend. What is the rate of dividend given to us in the question? It is 10, 15 and 20. So we understand it is 10%, 15% and 20%. So 100 rupees into 10%, dividend per share is 10. 100 rupees into 15%, dividend per share is 15. 100 rupees into 20%, it is 20 rupees per share. There are 20% chances that the dividend per share will be rupees 10. There are 30% chances dividend per share will be 15. And there are 50% chances dividend per share will be 20. So what will happen? It comes to 2 rupees, it comes to 4 rupee 50 paise and it comes to 10 rupees. That is the way, so the expected dividend per share can be calculated. 2 plus 4, that is 6, that is 16.5. This is what we understand is the expected dividend per share. It is 16 rupees 50 paise for security X. Next is the expected market price of the share. So working note number 2, calculation of expected market price of equity share. Let us see that's how it will be computed. Probability, market price of the share, probability into market price of the share. So over here the market price of the share information is given as probability 253. Okay, so I am writing over here it is 2, 5 and 3. Market price of the share is given as 220, 250 and 280. 220, 250 and 280. So probability into market price of the share, that will be 0.20 into 220, then 0.50 into 250, then 0.30 into 280. That is the way it will be calculated. So what will happen? 0.2 into 220, then 0.5 into 250. So in the first case it is 44, in the second case it is 125, and the last case 0.3 into 280, so it comes to 84. So the market price of the equity share at the end of the year is 253. So 253 is the price, that is we can say that P1. 44 plus 125 plus 84, that is 253 rupees price per share. So here is the market price of the equity share working note. Dear students, I have not prepared a combined working note. However, I have prepared separate working note because you can see that the probabilities are given differently. Over here you can see it is 235 and over here it is 253. That is the way the probabilities are given to us. So we have prepared the separate working note for doing answer. Then working note number 3. In that, calculation of return. Return will be calculated simple as D1 plus P1 minus P0 divided by P0 into 100. Of course, this return is of year 2015-16. Now, what is the dividend income? We can see that the expected dividend income is 16 rupees 50 paise. So it is 16.5 plus P1, it is 253 rupees per share, minus P0 stands for price of equity share at the beginning of the year. As per the information provided to us, price of equity share at the beginning of the year is 220 rupees. That is the price as on 31st of March, that is 2015. It is 220 rupees per share. Yeah. So divided by again 220 into 100 for getting answer in percentage term. So what will happen? It is 253 minus 220 plus 16.5 divided by 220 into 100 for getting answer in percentage term. It is 22.5%. That is the way we can make the computation of the return for security X. Whatever we have done for security X, similar to that we will do for security Y, and will make the computation of the return. Afterwards, again the weighted average. So new heading is security Y. Let us see that how to make the calculation of answer in case of security Y. In that, working note number 1, calculation of expected dividend per share. So it is probability dividend per share, probability into dividend per share. Okay. We can see that the dividend information is given over here. 235, that is the probability. It is 2, it is 3, and then it is 5. Okay. What is the rate of dividend provided to us? 15, 20 and 35. Face value is 10. So 10 into 15. Next is 20. So 10 into 20. And in the last case it is 35. So 10 into 35. Into 35. This is the return that we have in percentage term. So the amount of dividend per share is 10 into 15% is 1 rupee 50 paise. 10 into 20% is 2 rupees. 10 into 35% is 3 rupee 50 paise. That is the way, so the amount of dividend per share can be calculated. Amount of dividend will be multiplied with the probability. So there are 20% chances you will get 1 rupee 50 paise. Then there are 30% chances you will get rupees 2, and there are 50% chances you will get 3 rupee 50 paise. So 0.2 into 1.5, that comes to 0.30. 0.3 into 2, that comes to 0.60. Then 0.5 into 3.5, that comes to 1 rupee 75 paise. So the expected dividend is 0.3 plus 0.6 plus 1.75, 2 rupee 65 paise. That is the way we can make the computation of the expected dividend per share. Okay. Next is the calculation of the market price of equity share. Working note number 2. Calculation of expected market price of equity share. In that, again, column number 1 is the probability, column number 2 is market price of the share, probability into market price of the share. That is what we are required to do. So over here the price is 290, 310 and 330. 290, 310 and 330. What is the probability? 2, 5 and 3. So it is 2, 5 and 3. Okay, so now we can have the probability into market price of the share. So 0.20 into 290, then 0.50 into 310 and 0.30 into 330. That is the way we can make the calculation of answer. So over here 0.2 into 290, that comes to 58. 0.5 into 310, 155. 0.3 into 330, that comes to 99. Based on that, so we will make the calculation of the expected market price of equity share. So the expected market price of equity share is 312. So taking into account the dividend, taking into account the price of equity share and the price at the beginning of the year, will compute the return. Once we make the computation of the dividend and price, then calculation of return. In that, D1 plus P1 minus P0 divided by P0 into 100 for getting answer in percentage term. The expected dividend per share is 2 rupees 65 paise. Price of equity share at the end of the year is expected to be 312 minus dividend at the beginning of the price at the beginning of the period is 290. Whole divided by 290 into 100 for getting answer in percentage term. 312 minus 290, that is 22 rupees plus 2 rupees 65 paise, 24.65 divided by 290 into 100. So it comes to 8.5%. So we have computed, dear students, return of the individual security. Next will be calculation of the return of the portfolio. Calculation of return of the portfolio. How to make the calculation? Let us see. Column number 1 is security. Column number 2 is amount in a rupees term. Then weight or the proportion of the individual security in the portfolio multiplying with the return, which we already have found. Weight into return, that is the way the weighted average return will be calculated. So security X. We understand, dear students, that the number of shares are 1 lakh and the price is 220. So over here in amount column we will have 1 lakh is the number of shares into 220 is the price. So it is 220 lakhs. That is what we understand is the amount at the beginning of the period from security Y. Similar calculation, number of shares are 50,000, price is 290. So 50,000 into 290. So in that case it comes to 145 lakhs. $145 plus 220, 365 lakhs. That is the total value of the portfolio that you have. Okay. Now, as far as the weight is concerned, it is 220 divided by 365. So 0.6027. It is 220 lakhs divided by 365 lakhs. Next, for the other one, 0.6027 is subtracted from 1, 0.3973. So this is 0.3973. It is 145 lakhs divided by 365 lakhs. The total is again 1. Multiplying with the return. We have computed the return for the security Y, it is 8.5%. So this is 8.5. And similarly, we have done the return from security X. Return from the security X is 22.5%. We can see that it is 22.5% over here. So I am writing over here 22.5. So now 0.6027 multiplying with 22.5 and 0.3973 multiplying with 8.5. Okay. So 0.6027 into 22.5. It comes to 13.56, dear students, and 0.3973 multiplying with 8.5. It comes to 3.78. So it comes to 13.56 plus 3.78. 17.34%. So overall return of the portfolio is 17.34%. Friends, over here 0.3973 into 8.5 comes to 3.38, not 78, it is 3.38. So accordingly this will be calculated. So it is 13.56 plus 3.38, so it comes to 16.94. That is the return of the portfolio that we have. So this is the way we have, so the return of the portfolio. Dear students, importantly we are required to take weight for the year 2015-16 as the value of the security as on 1/4/2015, not the original price at which you had purchased the investment. So this is an important point that say you need to take into account. Rest of the working is not very difficult. Return of the portfolio is simple, that is weighted average. That is what we do every time. Now the question says importantly in the third part, advise Mr. A of the comparative risk in the two investments. So we are required to make the comparison of the risk. Of course, the risk calculation is not possible for the year 2014-15. It is possible only for the year 2015-16. So we are required to make the computation of, say, the standard deviation risk for each of the security in the year 2015-16. How to make calculation of that? Let us discuss it. Now dear students, over here importantly we can observe that the probability distributions have been given as 20, 30 and 50 and 20, 50 and 30. That is the reason this is not a normal question that we have usually. This is slightly a different kind of question. So over here, how we are required to calculate the answer, let us discuss that. I am discussing first of all in detail security X. Before I make the computation of the answer, I would like to have a small discussion with all of you. Dear students, if at all you have to make a, let us say, combination of AB and XY, then how many combinations are possible? We can say it is AX, AY, okay, then BX and BY. So can we say that there are total 4 combinations possible? Yes. Now if at all I tell you that you are required to make the combination of ABC and XYZ, it is ABC and XYZ, then we can say that's AX, AY, AZ. Similarly, BX, BY and BZ. Similarly, CX, CY and CZ. Is there any other combination possible? No. There are these 9 possible combinations that we have. Now, exactly the same thing is going to take place over here. We have been provided with the different probabilities for the dividend and different probabilities for the market price. So what happens, let's say we are required to work out that how many situations are possible if at all we make investment in the security. I am talking first of all for the security X. So how many possible situations that we have, that we will write. In each of the case, what is the return that we will compute. Dear students, you can write the return in rupees term or you may write the return in percentage term. Either of the way you can write it. I am assigning X variable to it, probability into X, that will give us mean value. Then X minus X bar, square of the same, multiplying with the probability, and with that we will make the computation of the standard, that is variance, and then under root of the same is the standard deviation. For each of the situation we will compute the return, and along with that we are required to make the computation of the joint probability. Yes, we are required to make the computation of the joint probability, then return. The term joint probability means probability of that specific situation. I explain that to you in detail. Let us say that situation number 1. Dear students, we can see that the face value of the security is 100 rupees. Yes. Rate of dividend is 10%. So 100 rupees into 10%, it comes to rupees 10. And the price per share increases by 0. Why? Because it was 220 and it remains 220. Okay, it was 220 and it remains 220. So in the first situation, there is only dividend income, that is a return. So in the first situation, we understand that it is 100 rupees into the rate of dividend is provided to us as 10%. That comes to rupees 10. And what is the appreciation in the price or change in the price? It is 0. Now what is the joint probability for this situation is very important to understand. It is 0.20 into 0.20. So 0.20 into 0.20 is 0.04. That is the joint probability. 0.20 into 0.20. That comes to 0.04. So there are 4% chances that the dividend will be, return will be rupees 10. Because the dividend income that you receive is the only income that you have. So keeping dividend same, how much? 10. And every time taking into account the change in the price, we will have the first 3 situations. See, I am writing the situation number 2. That will give you better idea, dear students. Say the price increases by rupees 30. So what happens at, say, you receive not only rupees 10 plus 250 minus 220. You receive additionally 30 rupees. So 30 plus 10, the overall return that you have is 40 rupees. Okay, now what is the probability, dear students? That 0.20 of the dividend is going to remain same, and this is 0.50. So it is 0.20 into 0.50. That comes to 0.10. Third situation, 0.20 into, the probability is 0.30 over here. So 0.20 into 0.30. That comes to 0.06. In that case, what will happen? Dividend is rupees 10 plus the price of the security increases to 280 from 220. So 280 minus 220. So 60 rupees is the price appreciation, 10 rupees is the dividend. So this comes to, I think that says 70 rupees per share. Like that, so the next 3 situation, that is situation number 4, 5 and 6. First of all, we will compute the dividend, and dividend rate is 15%. Face value is 100. So what will happen? We understand that it is 100 into 15%. You will get dividend of rupees 15, and that is your income. Situation number 5, situation number 6. Now 15 rupees is the dividend plus the price change over here is 30 rupees. So 15 plus 30, that comes to 45. And the price appreciation over here is 60 rupees. So 15 plus 60, that comes to 75. That is how we will compute the return. Okay. The probability is so over here the probability is 0.30. That is going to change. So probability is 0.3. Over here also it is 0.3, and over here also it is 0.3. Multiplying with the another probability is 2, 5 and 3 for the price. You can see it is 2, 5 and 3. So over here it is 0.2, 0.5 and 0.3. That is the way we have the probability. So 30 into 20, that comes to 0.06. 30 into 50, that comes to 0.15. And 30 into 30, that comes to 0.09. Okay. Then last set of the three situations. In that, dear students, first of all we'll write the dividend amount. We can see that the rate of dividend is 20%. 100 into 20%, that comes to rupees 20. Okay. So over here 100 into 20%, that comes to 20. In the next case 20 plus 30, that comes to 15. In the last case it is 20 plus 16, that comes to 80. That is how we will have the return. The probability in that, this return probability 0.5 is going to remain same. Then 253, 0.5 is going to remain same. 2, 5 and 3. Okay. So what will happen? 0.5 into 0.2, that comes to 0.10. 0.5 into 0.5, that comes to 0.25. 0.5 into 0.3, that comes to 0.15. Dear students, this joint probability will have total of exact 1. You can check the total like this. It is the joint probability 0.04 plus 0.10 plus 0.06 plus again 0.06 plus 0.15 plus 0.09 plus 0.10 plus 0.25 plus 0.15. It is exactly 1. So now what we will do, we'll compute the return, probability into return, that is the mean return. Then whatever the mean return that we have, based on that x minus x bar whole square into probability, summation of that is the variance, and under root of the same is standard deviation. You may not compute the standard deviation and you can compute only the variance, because the question says only that you are required to quantify that which security is more risky. So the security which is having the more variance will have the more standard deviation too. Please write down answer along with me if at all you are writing answer, dear students. So the probability into x. So now probability into return. Please write down answer along with me, probability into x. So 0.04 into 10, that comes to 40 paise. Then 0.10 into 10, 40. That comes to 4 rupees. Then 0.06 into 70. That comes to 4 rupee 20 paise. .06 into 15. That comes to 90 paise. Then 15%, that it will be 45 rupees. 6 rupees 75 paise. ₹75. For that, so there are 9% chances. Again, it is 6 rupees 75 paise. Then there are 10% chances. It will be 20 rupees. That comes to 2. There are 25% chances. it is 50 rupees, so it is 12.5. Then there are 15% chances it will be 80 rupees per share, so it is 12 rupees. That is the way the expected return can be calculated as 49.5. I was using the memory plus button. Let me just verify once again. 40 paise plus 4 rupees plus 4 rupee 20 paise plus 90 paise plus 6 rupees 75 paise, again 6 rupees 75 paise, plus 2 plus 12.5 plus 12, 49.5. Now after making the mean calculation, we'll do x minus x bar. So it is x minus x bar. What is the value of x? It is 10. Minus x bar is 49.5. So that comes to 39.50. Okay. Then 40 minus 49.5. So it comes to 9.5 negative. Then 70 minus 49.5, that comes to 20.5. Then it is 15 minus 49.5, it is 34.5. Then it is 45 minus 49.5, so it is 4.5 negative. 75 minus 49.5, so it is 25.5 positive. Then 20 minus 49.5, so it is 29.5 negative. Then it is 50 minus 49.5, that comes to 0.50. And lastly it is 80 minus 49.5, that comes to 30.5. This is the way we will make the calculation of x minus x bar. Now the last column. Last column will be, dear students, x minus x bar whole square into probability. Okay. So what will happen, it is negative 39.5 square multiplied with the joint probability 0.04. Next, negative 9.5 square into 0.10. Then 20.5 square into 0.06. Next, square of 34.5 into again 0.06. Next, square of negative 4.5 multiplying with the probability 0.1515. Next, square of 25.5 into probability 0.09. Next, square of 29.5 negative into probability 0.10. .5 square into 0.25. Last, square of 30.5 into probability is 0.15. Dear friends, the total of this is what we understand is the variance. So let us start with the working out the simple answer. So 39.5 square into 0.04, that comes to 62.41. Next, square of 9.5 multiplying with 0.10, that is 9.025. Next, square of 20.5 multiplying with 0.06, so 25.215. Next, square of 34.5 multiplying with 0.06, 71.415. Square of 4.5 multiplying with 0.15, 30.375. Next, square of 25.5 into 0.09, that is 58.5225. Next, square of 29.5 into 0.10, 87.025. Square of 0.5 into 0.25, 0.0625. We are very near to the answer, friends. Square of 30.5 into 0.15, that is 139.5375. Okay, this is the way we make the computation of x minus x bar whole square into probability. We make the total, it is 456.25. Yet we have to make the total, say, by individually. So we can make the total like this: 62.41 plus 9.025 plus 25.215 plus 71.415 plus 30.375 plus 58.5225 plus 87.025 plus 0.0625 plus 139.5375. Yes, we get the answer as 456.25. Friends, over here it is 3.0375, okay, because 4.5 square, it is 20.25 into 0.15, it is 3.0375. Friends, over here in this working, the logic is that, say, any of the combination is possible, any of the situation is possible by end of the year. That is, so the dividend will be rupees 10 and no appreciation. Dividend is rupees 10 and appreciation of 30. Dividend is 10 and the appreciation is 60. Like that, say one of the three situation, like that, say one of the 9 possible situations that we have. So for each of them, we have the concept called joint probability. This is similar to what you have studied at your intermediate level, that is in your chapter of risk analysis and capital budgeting. Okay, this is not end of the question, this is for the security X. Now we'll do it for security Y. So for security Y, we'll have the similar working, that is calculation of the return for each of the joint probability, and with that we'll make the computation of the variance. So write down heading security Y. Please write down answer along with me. Situation number 1 onwards. We'll mention joint probability. Dear students, we can see that the probability distribution is given same, so the joint probability is also going to remain same. So over here it is 0.04. It is 0.04. Return. What we can observe? We can observe that the price at the beginning of the year is 290. Over here also in the first 3 situations it will be 290. So no appreciation in the price. 10 rupees is the face value of the security, and rate of dividend is provided as 15%. So 10 into 15%, it is 1 rupee 50 paise for the first 3 situations. So the return will be in rupees term 1 rupee 50 paise in first situation, second situation and third situation. Joint probability is 0.10 and 0.06. 0.10 and 0.06. It is 1 rupee 50 paise itself, 1 rupee 50 paise itself. Next, for situation number 4, 5 and 6, probability is 6, 15 and 9. So it is 6, 15 and 9. Situation number 4, 5 and 6. In that case, what will happen, dear students? The rate of dividend is 20%. So 10 into 20%. This is 10, yes, into 20% is 2 rupees. And there is an appreciation in the price by 20 rupees. So what will happen? That over here it is, so the amount of dividend is 1 rupee 50 paise in the first case. In second case, what will happen? 1 rupee 50 paise is the dividend, and apart from that, say we are required to take into account the change in the price of the security. So what will happen? Amount of appreciation in the first case will be 0 because the price is going to remain same. So we have taken the return as 1.5. In the second case, what will happen? The price increases to 310. So what will happen over here? It is plus 310 minus 290. So there is an appreciation by 20 rupees. So the overall it comes to 21.5. In the last case, what will happen? There is an appreciation of 40 rupees. So over here plus 330 minus 290. So 40 rupees plus 1.5, that comes to 41.5. Okay. Then situation number 4, situation number 5 and situation number 6. The probabilities are same as what we already have found. It is 0.06, 0.15 and 0.09. So 6, 15 and 9. So 6, 15 and 9. Okay. Now what is the amount of dividend per share? It is 20% in the next case. Face value of equity share is given as rupees 10. 10 into 20%, that comes to rupees 2. So dividend is 2, 2, 2. Price appreciation in the first case is 0. In the second case it is 20 rupees, dear students. In the last case it is 40 rupees. So the income is going to be 2 rupees, then 22, and then it is 42. Then situation number 7, situation number 8, situation number 9. Okay, joint probability we have to take from here 10, 25 and 15. It is 10, 25 and 15. Okay, let us see the amount of dividend per share. Amount of dividend per share is 10 into 35%. So it is 3 rupee 50 paise. So it is 3 rupee 50 paise, 3 rupee 50 paise, 3 rupee 50 paise. Price change is 0. Then price change is rupees 20. And in the last case, the price change is rupees 40. Okay. So what will happen over here? It is 3 rupee 50 paise. Next, it is 23 rupee 50 paise. And last, it is 43 rupees 50 paise. That is the way we will have, say, the return in individual situation. Assigning y variable to it will compute the probability into y. That is the way we will compute the mean value. So what will happen, dear students? It is 0.04 into 1.5. Next, 0.10 into 21.5. And so on we will have the working. So I am writing answer along with the explanation. 0.04 into 1.5. That comes to 0.06. Okay. Then 0.10 into 21.5. That comes to 2.15. Then 41.5 into 0.06. That comes to 2 rupee 49 paise. Then 0.06 into 2. That comes to 12 paise. Okay. Then 22 into 0.15. That comes to 3 rupee 30 paise. Then 42 into 9%. That comes to 3 rupees 78 paise. Then 3 rupee 50 paise into 10%. That comes to 35 paise. Then 23.5 into 25%. That comes to 5.875. 43.5 into 15%. That comes to 6.525. With that, so we will make the calculation of y bar. Yeah, let us make total of is 0.06 plus 2.15 plus 2.49 plus 0.12 plus 3.3 plus 3.78 plus 0.35 plus 5.875 plus 6.525. That is the way y bar comes to 24.65. Now next column will be y minus y bar whole square into probability. So what will happen? It is 1 rupee 50 paise in the first case minus y bar is 24.65. So it is y minus y bar, its square into probability is 0.04 in the first case. Second case it is 21.5 minus 24.65 raised to 2 into probability is 0.10, and so on. Further calculation will be made. So 1.5 minus 24.65, difference of that is 23.15, its square into 0.04, that comes to 21.4369, 21.4369. Then 21.5 minus 24.65, that is 3.15, its square into 0.10, that comes to 0.99225, 99225. Next, it is 41.50. Next, it is 41.5 minus 24.65, square of that, multiplying with the probability 0.06. So over here 41.50 minus 24.65, that is 16.85, its square into 0.06, that is 17.04, 17.03535. Okay, next it is 2. Okay, this value is only 2, so 2 minus 24.65, its square multiplying with the probability is 0.06 once again. Okay, so over here 2 minus 24.65, so it is 22.65, its square multiplying with 0.06, so 30.78, 135. Okay, next it is 22 minus 24.65, its square into probability is 0.15, 22 minus 24.65, so it is 2.65 negative, its square into 0.15, so 1.05, 3375. Okay, next 42. So over here it is 42 minus 24.65, its square into 0.09. Okay, so 42 minus 24.65, 17.35, its square into 0.09, it comes to 27.09. Okay, next 3.50, so it is 3.50 minus 24.65, square into probability is 0.10. .5 minus 24.65, so 21.15, its square into 0.10, so 44.73. Then 23.50, we are very near to the final answer, dear students. 23.50 minus 24.65, its square into probability is 0.25. So 23.5 minus 24.65, so 1.15 negative, its square into 0.25, that comes to 0.33. Okay, next it is 43.56 minus 24.65 raised to 2 into probability is 0.15. 43.5 minus 24.65, so it is 18.85. Its square into 0.15, that comes to 53.30. Yes. Now we'll make the total, the final answer. 21.4369 plus 0.99225 plus 17.03535 plus 30.78 135 plus 1.05 3375 plus 27.09 plus 44.73 plus 33 paise plus 53.30. So it comes to 196.749225, or we can say 75 also. That is the way we can make the computation of the variance. So now security X and security Y, we have made the computation of the simple variance. For the security X, it is 456.25. So over here it is 456.25. When you make under root of the same, you will get the standard deviation, and it comes to 21.36. And this standard deviation is calculated in rupees term. Okay. Similarly, for Y security, 196.74, 196.74 or 75 we can write, and then its under root is 14.03 rupees. What is that is question? The question says that advise Mr. A of the comparative risk in the two investment. So we understand that this is the risk that investor has comparatively in these two securities. So we can say something like this, that we have computed even the return over here is 49.5 and the return over here is 24.65. So the return, it is 49.5 and over here it is 24.65. And if at all we make the computation of the return in percentage term, then 49.5 is the return on the price of 220. So the return is 22.5%. Okay, in the second case it is 24.65 divided by 290, that is the price, so it is 8.5%. So over here return is 8.5%. So we can say that as far as the security X is concerned, its return is higher, at the same time it has more risk. That is what we can say from the given calculations or from the calculations that we have made. This is the conclusion that we can draw. B part of the question. Okay, going back to the last question, friends, I feel that over here computation of the risk of the security was like quite tricky that we had in this question, because we had to find all the possible situations with respect to the dividend, with respect to the market price. For each of them we have to find the joint probability. For each of them we have to find the return, and that is the way we are required to make the computation of answer. We had to do it for the security X as well as for security Y. So the huge calculation that we had to make, say in terms of calculation of the risk. Rest of the portion was not very difficult. I would say that the rest of the portion was quite simple, easily that you can attain. B part of the question, explain the various problems that are faced in growth of securitization of the instruments in Indian context. So what are the challenges which the securitization is facing? Following are the main problems faced in the growth of the securitization. So certain issues which are faced in the growth are like this, especially in the Indian context. First is the stamp duty, second is income tax, the third is accounting, fourth is lack of standardization, fifth is inadequate debt market, ineffective foreclosure laws. These are the limitations that we have. First of all, having a broad discussion, because head points is what I think is important. We understand that the stamp duty is required to be paid when this process is going on, that is that when this process takes place, and because of that this transaction becomes expensive. Income tax is required to be paid, and we understand that over here, basically even for the income tax the clarity is not there as such. For the accounting, again there is no standardization. Then the lack of the standardization in terms of the procedure for execution of the entire transaction. Sufficient market is not there, so the number of players in the market are less. Ineffective foreclosure laws, it says that basically if at all somebody is not making repayment of the loan, then in that case the clauses that we have for recovery is not very effective. These are the certain limitations that we have. So let us read now one by one. Stamp duty is one of the obstacles in India. Under the Transfer of the Property Act 1882, a mortgage debt stamp duty, which even goes up to 12% in some states of the India, and this impeded the growth of securitization in India. It should be noted that since pass-through certificate does not evidence any debt, only able to receive, they are exempted from the stamp duty. So we understand it is PTC, pass-through certificate are exempted. Moreover, in India, the recognizing the special nature of securitized instrument in some states, not everywhere in the India, has reduced the stamp duty on them. Income tax. Taxation is another area of concern in India. In absence of any specific provision relating to the securitized instrument in income tax, experts' opinion differ a lot. Some are of the opinion that special purpose vehicle or special purpose entity as a trustee is liable to be taxed in a representative capacity, then others are of the view that instead of special purpose vehicle, investors will be taxed on their share of the income. Clarity is also required on the issue of the capital gain implication on passing the payment to the investor. Accounting and the reporting of the securitized asset in the books of the originator is another area of the concern. Although the securitization is slated to be an off-balance sheet instrument, but in a true sense, receivables are removed from originator's balance sheet. Problem arises especially when the assets are transferred without recourse. Without recourse means that so the originator is like the financial intermediary is not responsible if at all there is no repayment of the loan. That is what it says. Lack of standardization. Every originator means every financial intermediary following his own format for documentation and administration. Having lack of standardization is another obstacle in the growth of securitization. Inadequate debt market. This is something which is very important from the capital market point of view. Lack of existence of the well-developed debt market in India is another obstacle that hinders the growth of the secondary market of the securitized or asset-backed securities. So basically what happens is the investors are not having a kind of assurance of the secondary market. So if at all they have the planning of making investment for short term, they may not select this kind of securities. Ineffective foreclosure laws. For many years, efforts are on for effective foreclosure, but still foreclosure laws are not supportive to the lending institution, and this makes the securitized instrument, especially mortgage-backed security, less attractive as lenders face difficulty in transfer of the property in the event of the default by the borrower. This is what we have. Next, C question. Explain the various market indicators. That is a question. Following are the major market indicators. It is the breadth index. Next, volume of the transactions. Confidence index. Relative strength analysis. Odd lot theory. So these are the 5. Let us read. It is an index that covers all securities traded. It is computed by dividing the net advances or declines in the market by the number of the issues traded. Breadth index either supports or contradicts the movement of Dow Jones averages. It supports the movement of Dow Jones averages. This is considered the sign of the technical strength, and it does not support the averages. It is a sign of the technical weakness. That is a sign that the market will move in a direction opposite to the Dow Jones averages. Breadth index is an addition to the Dow Jones theory and the movement of the Dow Jones averages. Next is the volume of the transactions. The volume of the shares traded in the market provides useful clue on how the market would behave in the near future. A rising index or the price with increasing volume would signal buy behavior because the situation reflects an unsatisfied demand in the market. Similarly, a falling market with increasing volume signals a bear market, and prices would be expected to fall further. A rising market with decreasing volume indicates a bull market, with a falling market with dwindling volume indicates bear market. Thus, the volume concept is best used with another market indicator. So this is important. Another market indicator, we have to take them together, such as Dow theory. Confidence index. It is supposed to reveal how willing the investors are to take a chance in the market. It is the ratio of the high grade bond yield to low grade bond yield. It is used by the market analysis as a method of the trading or timing the purchase and the sale of the stock, and also as a forecasting device to determine the turning points of the market. A rising confidence index is expected to precede a rising stock market, and fall in the index is expected to precede a drop in the stock prices. A fall in the confidence index represents the fact that low-grade bond yield are rising faster or falling more slowly than high-grade yields. The confidence index is usually, but not always, a leading indicator of the market. Therefore, it should be used in conjunction with other market indicators. Next is RSI, relative strength analysis. The relative strength concept suggests that the prices of some securities rise relatively faster in bull market or decline more slowly in bear market than other securities. Some securities exhibit relative strength. Investors will earn higher returns by investing in securities which have demonstrated relative strength in the past, because the relative strength of the security tends to remain undiminished over the time. Relative strength can be measured in several ways: calculating rates of return and classifying those securities with historically high average returns as securities with the high relative strength is one of them. Even ratios like the security relative to its industry and the security relative to the entire market can also be used to detect relative strength in a security or an industry. Next is the odd lot theory. This theory is a contradictory opinion theory. It assumes that the average person is usually wrong and that a wise course of the action is to pursue strategies contrary to the popular opinion. The odd lot theory is used primarily to predict tops in the bull market, but also to predict reversal in individual securities. Our question: explain the term angel investor. Despite being country of many cultures and communities, traditionally inclined to business and entrepreneurship, India still ranks low on the competitive rating across entrepreneurship, innovation and ease of doing business. The reasons are obvious. This includes our old and outdated draconian rules and the regulations which provides a hindrance to our business environment for a long time. Other reasons are red tapeism, our time-consuming procedure, and lack of general support for entrepreneurship. Of course, these things are changing in the recent times. As per Investopedia, angel investors invest in small startup or entrepreneurs. Often, angel investors are among an enterprise, family, and friends. The capital angel investors provide maybe one-time investment to help the business proposal propel, or an ongoing injection of the money to support and carry the company through its difficulty in early stages. Angel investors provide more favorable terms compared to other lenders, since they usually invest in the entrepreneur starting the business rather than the viability of the business. So we understand that basically whenever any of your friend or any of your relative is making investment, then basically they trust you or they want to encourage you, and because of that they make an investment. They are not making investment basically in a business, they are making investment basically say in a person, in the relationship. Angel investors are focused on helping startups take their first step rather than possible profit that they may get from the business. So they are basically say having an intention not to earn the profit but to help you. Essentially, angel investors are the opposite of venture capitalists. Angel investors are also called informal investors. Angel founders, private investors, seed investors, or business angels. These are affluent individuals who inject capital for the startup in exchange for the ownership equity or convertible debt. Some angel investors invest through crowdfunding platform online or build angel investor network to pull in capital. So there are a number of investors who make investment, and that pool of the funds is invested in certain different kind of individuals, different kind of loan. Angel investors typically use their own money, unlike venture capitalists who take care of the pooled fund, that is money from many other investors, and place them in a strategically managed funds. Though angel investors usually represent individuals, the entity that actually provides the fund may be a limited liability company, a business, a trust, or an investment fund, among many other kind of vehicles. Angel investors who seed startup that fail during their early stages lose their investment completely. So if at all unfortunately the venture is not successful, then in that case they tend to lose the entire amount. This is why the professional angel investors look for opportunities for a defined exit strategy, acquisition, or the initial public offering. This is what we can say about the angel investor. Next, question number 6A. XYZ Limited has imported goods to the extent of $8 million. That is 80 lakhs of dollar, which is required to be paid by XYZ Limited for import of goods. The payment terms are as under. First, 1% discount if full payment is paid immediately, or 60 days interest with credit. However, in case of further delay up to 30 days, interest at the rate of 8% per annum will be charged for additional days after 60 days. Messrs. XYZ Limited has rupees 25 lakhs available, and for the remaining it has an offer from the bank for a loan up to 90 days at the rate of 9% per annum. The quotations for the foreign exchange rates are as follows. Spot exchange rate is provided to us for buying US dollar is rupees 66.98. 60 days forward exchange rate is given rupees per dollar. To purchase United States dollar is 67.16, and 90 days forward exchange rate is given 68.03 rupees per dollar. Advise which of the following option would be better for XYZ Limited. First, make payment immediately after utilizing the cash available, and for the balance amount, take 90 days loan from the bank. Pay supplier on 60th day and avail bank's loan after utilizing the cash for a time period of 30 days. Avail supplier's offer of 90 days credit and utilize the cash available. Further, presume that the cash available with XYZ Limited will fetch, means will earn a return of 4% per annum in India till it is fully utilized. Assume 360 days in a year and ignoring income tax. Compute your working up to 4 decimals and cash flow in rupees in crores. So the clarification is made that so you're required to make the computation of rupees in crores and you're required to work out the answer up to 4 decimal. So we understand that say the answer will be like this. Answer of question number 6A, in that we are required to write the answer into 4 decimal points and we are required to mention the answer amount in crores of rupees. Okay, let us see that say how to make the computation of answer. First of all, understanding that's the question, we can say that say basically say that is an Indian company. And this company has entered into a transaction of importing of goods. And this company is required to make payment of 8 million United States dollar. That is what's the amount of payment which is required to be made. Basically, there are 3 options that we have of making payment: today, after 60 days and after 90 days. The supplier has offered us that say if at all you make payment right now, then in that case there is cash discount at the rate of 1%. If at all you make payment after 60 days, then no advantage of discount. And if at all you make payment after 90 days, then in that case, interest is to be paid. For 30 days. How this 30 days is provided to us, friends? 90 minus 60. Because as far as the initial 60 days is concerned, for that, so there is interest free credit which is given to us. Apart from all this, we have been provided with the information that so there is excess cash available with the company right now, an amount of rupees 25 lakhs. And this can be invested at the rate of 4%. If at all you are making payment later on, then in that case, what happens? Over here, so for this time period, you are required to make the payment of interest. The rate of interest is specified by them is 8%. This is at the rate of 8%. Okay. Now, if at all you make payment early, then in that case, so you are required to borrow funds. And for borrowing of the funds, you will be required to pay interest at the rate of 9%. So, interest rate for borrowing is 9%. Next, we can see further that the spot exchange rate is given to us 66.98. Spot is given 60 days forward is given, and 90 days forward is given. Spot is 66.98. Sixty days forward is 67.16. And 90 days forward exchange rate is 68.03. That is the way the information is provided to us, and we are required to decide, let's say, what the company should do. Let us go one by one with the options, not applying our, that is the mind, and we'll just make the computation of the answer as per the instruction given. The first is make payment immediately. So we understand like this. Dear students, 1 million is equal to 10 lakhs. So 8 million is equal to 80 lakhs. Okay. Now you make payment immediately. So what will happen, dear students? You'll get 1% cash discount. So 80 lakhs minus 1%. That comes to 79 lakh 20,000. That is required to be paid. Okay, if at all you make payment right now, then the exchange rate applicable will be 66.98. So into 66.98. So the answer that comes in the calculator, 53 crore 4 lakh 81,600. This is the amount that we are required to pay. The question says that, say, after utilizing the cash available. Okay, what is the amount of the cash available? It is 25 lakhs. So I'm deducting 25 lakhs. So the amount that we need to borrow is 52 crore 79 lakh 81,600. Pay immediately after utilizing the cash available, and for the balance amount, that is this amount which I have recently spoken, 52 crore 79 lakh 81,600. Take 90 days loan from the bank. Of course, friends, we understand that we are required to take the loan from the domestic bank, and in that case the rate of interest will be 9%. So whatever this answer that we have, into 9% into 90 divided by 360. So the amount of interest is 1 crore 18 lakh 79,586 plus the amount of the principal. That is the way we'll calculate the total amount. That is the way first option will be found. And so on, the further answer is there, that we will see. Let us go gradually one by one. So over here we understand that, say, the total invoice amount, yes. Minus discount, yes. Whatever the remaining amount into spot exchange rate, that is the amount that we require to make payment. Okay, that is the amount of the rupees which is required to be converted to United States dollar, and that amount will be, say, paid to the supplier. Now whatever the amount that we require, from that, so the 25 lakhs that we have, so that will be deducted. So whatever the remaining amount that we have is the amount that we need to borrow. The amount that we are going to borrow, for that say we are going to make payment of interest at the rate of 9% and for a time period of 90 days. This is the simple working that say we are required to do. So let us now work out the answer in detail. Dear students, over here, so the condition is provided to us that you are required to work out the answer into 4 decimals and you are required to calculate the answer in rupees in crores. So taking that additional conditions into account, we are required to make the calculation of answer. So let us answer the question. Option number 1. Make payment today. The first option is that say you make payment today. In that case, working note number 1, calculation of amount of rupees required. Okay, we understand that it is like this: rupees and dollar. Dear students, what is the spot exchange rate? Spot exchange rate is this: 66.98. 66.98 rupees for every $1. Now, it is 80 lakhs minus 1%. So that comes to 79.2 lakhs. It is equal to this amount of rupees. 79.20 lakhs into 66.98. So in that case it comes to 53.0482 crore. 53.0482 crore. So this is the amount of the rupees which is required. Okay. Working note number 2, calculation of amount of loan taken. Let us see that say what is the amount of the loan taken. So it is 53.0482 crore minus the amount of borrowing is 0.25 crore. That is minus the amount of the cash which is available with us. And if I am not wrong, it is 25 lakhs. Okay. So we understand that say we are required to make the computation of the amount of borrowing, and it is 52.7982. So what happens, friends? Let's say this is the amount that we are going to borrow. What is the rate of interest for borrowing provided to us? Let us see. We have been provided that the rate of interest for borrowing is 9% per annum for a time period of 90 days. So, working note number 3. Calculation of repayment of loan. So it is principal plus interest. This is the amount of the loan that we have borrowed, 52.7982 plus 52.7982 into rate of interest is 90, that is 9%, and the time period is 90 days. That is the way we will compute the interest amount. So over here it is 52.7982 plus, so into 9% into 90 divided by 360, 1.1880. Just be careful for some small instructions that say they provide your students. Let's say you are required to work out the answer in crores of rupees. You are required to work out the answer in like 4 decimals. So 53.9862. So this is the amount of the repayment of loan in crores of rupees. This is what we understand is the option number 1 that we have. Okay. Now what is the second option? Let us see. The second option is provided like this, that pay the supplier on 60th day and avail the bank loan after utilizing the cash for a time period of 30 days. Now basically, dear students, what happens is we are required to make all the options comparable at a particular point of time. That is like 90 days over here in this example. So if at all you are making payment at the end of the 60 days, then in that case, listen me carefully, let's say if at all you are making payment at this point of time, then in that case you will not get the advantage of the cash discount. However, what happens that whatever this amount that you have with you, for that, so you will get the interest income at the rate of 4%. Even at this point of time, whatever the amount that you require, that is definitely more than the amount which you have. So whatever the difference, for that say again you are required to consider the cost of borrowing of the funds for a time period of 30 days. This is the way we are required to make the calculation of answer. Okay, now option number 2. The second option is make payment after 60 days and borrow for 30 days. Okay, that is the second option. So in that case, dear students, working note number 1 once again, very simple. Calculation of amount required. At the end of 60 days. That is the amount for which the forward contract is required to be taken up. We understand it is rupees and dollar. So 60 days forward exchange rate is given to us in the question as here 67.16. So here it is 67.16 rupees for every $1. So how much rupees for 80 lakhs US dollar? So what will happen? It is 67.16 into 80 lakhs whole divided by 1. So it comes to, friends, 53.728. So rupees 53.728 crore. Working note number 2. Calculation of amount of borrowing. Now friends, over here the language of the question is very clear, that pay supplier on 60th day. Now of course you require 53.728 crore and avail bank loan after utilizing the cash. What is the amount of the cash available with us? It is 0.25 crore. So the amount of borrowing will be amount required minus amount available. What is amount required? Amount required is 53.728 crore minus 0.25 crore. That comes to 53.478 crore. So this is the amount that we need to borrow. Of course, this amount is supposed to be borrowed only for 30 days. So working note number 3, calculation of overall cost. In that, friends, what will happen? We understand it is the principal amount plus interest for 30 days minus interest received for 60 days. Because what will happen, the 25 lakh rupees which we have used on 60th day, we understand that say on that we must have earned the interest income for 60 days. What is the amount of the principal? We understand that the principal amount is this 53.478 crore. That is the amount that we must have borrowed on 60th day for making payment, plus interest for 30 days, that is 53.478 into the rate of interest is 9% and the time period is 30 days. This is 9% and the time period is 30 days. So this is the interest amount minus interest received. So 0.25 crore, on that you will receive interest at the rate of 4% into, we understand that say you have received interest for 60 days. Because what happens at on 60th day, this amount has been used for making payment to the supplier. So 53.478 into 9% into 30 divided by 360. That comes to 0.4011. So 53.478 plus 0.4011 minus 0.25 crore into 4%, that is 0.01 crore into 60 divided by 360. That comes to 0.0017 crore. It reduces the cost because you get the interest income. So 53.478 plus 0.4011 minus 0.0017, that comes to 53.8774 crore. Okay, so this is the amount of the cost that we have on 90th day term, that is for option number 2. This is the option number 2, for which we have the overall cost like this. Okay, now the third option, avail the supplier's offer of 90 days credit and utilize the cash available. Okay, so in this case what will happen? Option number 3. Make payment to supplier on 90th day. So that is the point at which you will make the payment. So what will happen, dear students? First of all, we are required to make the computation of the interest which the supplier will charge to us, because for the first 60 days it is interest free. From 60 days to 90 days, like for a time period of 30 days, we are required to make payment of interest. What is the rate at which we have to make the payment of interest? We can see that the interest is required to be paid at the rate of 8% here. So what will happen? That's the amount which is payable in dollar currency will increase. That is 80 lakhs plus some amount of interest. Now for this we will enter into the forward contract, sell of rupees and purchase of dollar. Whatever the amount that we have to pay, from that the 25 lakh rupees which we had will be deducted. And of course this 25 lakhs must have been invested by us at the rate of 4% for 90 days. So accordingly we are required to consider the interest income on this for a time period of 90 days. This is what we understand. So I break up the working notes like this. Please write an answer along with me. Working note number 1, calculation of total amount to be paid in dollar currency. So it is principal plus interest. The term principal stands for 80 lakhs that you are required to pay, and you are required to make payment of interest at the rate of 8%. So 80 lakhs into 8% into time period of borrowing is 30 days. Okay. So we'll make the computation of the answer accordingly. It is 80 lakhs plus 80 lakhs into 8% into 30 divided by 360. That comes to 53,333. So $80 lakh 53,333.33. This is the amount which we are required to pay after 90 days. Okay. Then working note number 2. Calculation of amount payable after 90 days. So again the exchange rate rupees dollar. We can see that the exchange rate is provided to us as 90 days forward 68.03. So it is 68.03 rupees for every $1. Now the amount of dollar which we have is an amount of, that is amount which we have to pay is 80 lakh 53,333.33 and it is equal to this amount of rupees. So it is 80 lakh 53,333.33 multiplying with 68.03. Whole divided by 1. $8053,333.33 into 68.03. So it comes to rupees 54.7868 crore. 54.7868 crore. This is the amount of the rupees that we are required to pay. So now the final answer is calculation of the overall cost. In that we understand it's the amount payable minus amount available minus interest income. What is the amount payable? It is 54 crore. So it is 54.7868 crore minus amount available is 0.25 crore minus 0.25 crore into rate of interest is 4% and the time period is 90 days. So 0.25 into 4% into 90 divided by 360. So it is 0.0025 crore. So 54.7868 crore minus 0.25 crore minus 0.0025 crore. With that, we'll have the final answer. 54.7868. So the final answer is 54.5343. So this is the amount of the rupees, say, which you are required to pay in the third option. Now friends, we are required to make a comparison of all the options, and the option which is having, so the lowest cost will be selected. So finally, summarizing option, the first is you make payment today, you make payment after 60 days, and you make payment after 90 days. So amount of rupees in crores, 54.5343. That is option number 3. And the second option is 53.8774. And the first option is 53.9862. That is the way we are required to make the comparison, and of course we are going to select the option which is having the lowest cost. That is over here, 60 days is the time period. Afterwards you should make the payment. So over here we can advise the company that you should make the payment after 60 days. So the final decision, payment should be made after 60 days. This is what we understand. Okay. Now dear students, one thing that say the answer which I have provided is of course influenced with the suggested answer of the institute. At the same time for the second option, because for the first and third option I think that the working is exactly the conceptually as what it should have been. However, in the second case, there is a small point which I want to discuss with you, my personal opinion. See, this is the amount that we are required to pay after 60 days. Okay. Then, so the amount which is available, which I have calculated over here or I have mentioned over here is 0.25 crore. Going with the language of the question, in which they have specified, that say we are going to utilize the amount which is available. Instead of only 0.25 crore, if at all as a student you consider this additionally 0.0017 crore, I think that it is also acceptable. Why? The reason for that is like this. Day 0 you have made investment of 0.25 crore. So day 60 you will be having 0.25 crore plus 0.0017 crore. At that point of time, say you require 53.728 crore. This is the amount which you require. Now this amount which you require, from that say 0.2517 crore which you have the balance with you, that you can utilize, and only the remaining amount you need to borrow. In that case, what will happen? So the amount of the borrowing will reduce to some extent. That is say, with the interest income 0.0017, and accordingly, so this interest liability is also going to reduce. And with that, so the final answer that say you can compute taking into account say the net cost, because this 0.0017 income will be considered automatically in terms of the reduced borrowing, and with that so we will have the final answer. In that case, of course, this option is going to be still more cheaper, still more less expensive, and coincidentally say even the second option is only selected. This is what say a kind of my personal opinion that I have say with respect to the working. Question number 6b, next question. A company is long. Long means it has, that is, it is in the possession of 10 metric ton of the copper at the rate of 534 rupees per kg spot, and intends to remain so for the ensuing quarter. The variance of the changes in spot and the future prices are 16% and 36% respectively, having correlation coefficient of 0.75. The contract size of one contract is 1000 kg. The first question, calculate the optimum hedge ratio for perfect hedging in the futures market. Second, advise the position to be taken in futures market for perfect hedging. Third, determine the number and the amount of the copper futures to achieve a perfect hedge. That is a question. So let us have understanding about this hedging question. Basically, friends, we understand that say that the company is having such a long position in the cash market, so it has a fear that the price of the commodity may fall down. So to cover up the loss for the reduction in the value of the inventory, what it has to do, it has to enter into some transaction in the futures market so that it can cover up the loss in terms of the reduction in the value of the commodity. The first question is, you are required to compute the optimal hedge ratio. So answer of question number 6b. In which we are required to compute the optimum hedge ratio. Yes, 6b is the answer. It will be calculated like this. It is correlation coefficient into standard deviation of the spot divided by standard deviation of the futures. This is a simple formula which we are required to apply. Now you have been provided with the variance information. We require standard deviation. However, they have provided variance. No problem. It is very simple for us to make the computation of the standard deviation based on the variance. R is provided as 0.75. So it is 0.75 into under root of 16 divided by under root of 36. That is correlation coefficient into standard deviation of the spot divided by standard deviation of the futures. So what will happen over here? It is 0.75 into root of 16 is 4 and root of 36 is 6. So what will happen, dear students? We understand as it is 0.75 into 4 divided by 6. So it comes to 0.50. So the hedge ratio is 0.50. That is the way we can get answer for the very first working. Okay. Let us read the further question. So the first answer is hedge ratio, that is 0.50. Second is advise the position to be taken in the futures market for perfect hedging. Okay, we understand that say you have the long position in the spot market, and in order to have the hedging, what you will do, you will enter into the short position in the futures market. That is the way you will go for the hedging. So answer of the second question, as the company has long position in cash market, comma, so the company will enter in short position in futures. So in futures, so the transaction will be entered upon for sale. Why? Because you are having such a long position right now. Logically, we understand like this: if at all the value of the commodity is decreasing, then in that case, in the spot, that is whatever the inventory which you are holding with you, for that so the value will decrease and you will incur a loss. However, as you already have entered into the transaction for sale, so you will be able to purchase at a lower value to sell at a predetermined higher value, and with that you will be able to make the profit of the difference. If at all the prices are moving up, then in that case what will happen? We understand logically like this. Listen to me carefully, that if at all the prices are going up, then in that case your existing inventory value will go up and you will make a profit. However, at the same time, so the prices have gone up, so even the futures prices must have gone up. You have entered into the transaction for sale, so you have to buy at a higher value and sell at a predetermined lower value, and in that case you have to bear a loss. Of course, the hedging is going to will save you in case of a loss, but if at all you have a profit, then in that case you are required to share your profit. You are required to sacrifice your profit to that is to some extent. Without hedging, you have a situation like this. So without hedging, your position will be like this. You will have huge volatility. Now with hedging, what happens that so your position changes to this, in a way that say you will be having such a lower loss and lower profit. Third point, that is third question's answer. Determine the number and the amount of the copper futures contract for a perfect hedge. Now we understand like this, that calculation of quantity of copper for which short position will be entered upon. Now what is the quantity for which the short position will be entered upon? So it is 10 metric ton multiplied with 1000 kg, because we understand that so the 1 metric ton is equal to 1000 kg. So 10 metric ton is equal to 10,000 kg. This is what's the copper that you have with you spot, multiplied with hedge ratio. What is hedge ratio? 0.50. So it comes to 5000 kg. So we understand that say we will enter into the short position for 5000 kg. That is what we understand. and number of contracts. It is 5000 kg divided by lot size. What is lot size? Lot size is 1000 kg. So it comes to 5 contracts. This is the way we can compute the number of contracts for which the futures contract will be entered upon. Okay. Now value. The question says that you are required to convert that into value also. So it is number of contracts into lot size into price. Number of contracts are 5, lot size is 1000 and the price is rupees 474. Sorry, 534. It is 534. So what will happen, dear students? 5 into 1000 into 534. So it comes to 26,70,000. This is the way we are required to make the calculation of answer. Now, dear students, there is one point to which I want to draw your attention is that, say, suppose over here the lot size is not 1000 kg. The lot size is, let us say, 900 kg, for example. Then 5000 upon 900, it comes to 5.56. That is the answer that we get. Then you may write 6 contracts, you may write 5 contracts. Like that, so you may write any number of contracts which is near to the number of contracts for which you got the answer. Over here, coincidentally, we are getting exactly the same number of contracts, that is 5 non-integer value. Had there been an integer value, then in that case you are required to round off on either of the side. There are no hard rules and regulations that say you have to round off to the upper only, round off to the lower only. Because over here, approximately you have to make sure that, say, you are entering into the hedging transaction. C question. Examine briefly the various innovative methods of funding startup. Here are some of the innovative sources of funding a startup. The first is person financing. It may not seem to be an innovative, but you may be surprised to note that most budding entrepreneurs never thought of savings any money to start a business. This is important because most of the investors will not put money into a deal if they see that, say, you have not contributed any money from your personal sources. The second is the personal credit lines. So if at all you yourself can raise the funds based on your own credit worthiness, one qualifies for the personal credit line based on one's personal credit factors, that is efforts. Credit cards are a good example of this. However, the banks are very conscious while granting the personal credit lines. They provide this facility only when the business has enough cash flow to repay the line of the credit. Family and friends. These are the people who generally believe in you without even thinking that your idea works or not. So it is on the emotional or it is based on the personal bonding that you are able to get the funds. However, the loan obligations to friends and the relatives should always be in writing as a promissory note or otherwise. The next is the peer-to-peer lending. In this process, a group of the people come together and lend money to each other. Peer-to-peer lending has been there for many years. Many small and ethnic business groups having similar faith or interest generally support each other in their startup endeavors. Dear students, for peer-to-peer, we can say something like this. All of us are aware of the concept called Uber. All of us are aware of the concept of Zomato. Uber does not have, say, its own fleet of the cars. Uber is only, we can say that's the intermediary between a person who wants to travel from car and say maybe a driver who owns a car. The driver owns a car. So basically a driver owns a car and somebody wants to go from one place to another place. So Uber is the place at which say this person is booking, let's say I require a car for this specific purpose. Uber is only an intermediary between these two parties, and with that the transaction takes place. At the same time, say somebody wants to eat, let us say dosa or let us say idli, something like that. There is a restaurant. So the restaurant is basically preparing the food. Now, Zomato is again a kind of intermediary. Zomato is a place where say this person is placing an order, then from Zomato a person is going to this restaurant, taking the food and it delivers say to this person. This is part of the concept that we understand is of Zomato. Zomato itself is not cooking anything. Exactly the same concept is there in case of peer-to-peer lending. Basically in peer-to-peer lending, what happens at say there is like a platform over which there are number of like the traders or number of investors who have registered themselves that say I want to lend, I want to lend, I want to lend. So like that say there is a pool of the funds which this platform is getting, e-platform. There are a number of the borrowers who come to this platform for the purpose of getting the loan. This peer-to-peer lending platform is basically working as an intermediary between both of them. So it will analyze the proposals, it will look into the matter, let's say whether the proposal is genuine or not, whether the requirement of the funds is like for the business purpose or for which purpose, what kind of security, like that. So the entire processing of the analyzing the proposal is done by this, like the officials of the peer-to-peer lending. Afterwards, whatever the amount which has been raised will be say invested over here. Whatever they earn, that is distributed to the lenders. This is what we understand. Basically, we understand that say it works like a bank. However, in case of bank, what happens at say the overhead expenses are very high. That is the reason it becomes very expensive for the borrowers to borrow, and at the same time the lenders are not getting such a good return. Whatever the rate at which the borrowers are making payment of interest and whatever the rate at which these borrowers are getting return, between them there is a huge gap in case of bank. So there is an effort of reducing this gap, and this is a kind of innovative idea that you have with which you will be able to get the funds faster. You will be able to get the good investment opportunity from investor point of view. And this peer-to-peer is like all the platforms are under the governance of the Reserve Bank of India. That is the way we can say that say relatively there is a control. Even banks are under the governance of Reserve Bank of India, but yet we have seen like number of bank frauds, and that is really very alarming situation for the country. If at all, so the banks default every now and then in that case the investors are really facing a very big difficulty That's where they are safe. Where should they put their hard-earned money? Not getting interest is a challenge that they already are facing, that is very less rate of interest. And at the same time, say whatever the principal amount, for that also there is an insecurity. And all this is like majorly due to the corruption that we have, which is what we understand is a factor over which, say, like the politicians have to work a lot, and with that, say, we will be able to come out of this situation. Crowdfunding is almost a similar concept as the peer-to-peer lending. Over here, in case of crowdfunding, what happens that, say, again there is like an e-platform. Maybe like initially it was used for the purpose of the social activity. Like for example, it happens like this, that say somebody who is having like the very moderate income, and unfortunately his son is, say, detected with cancer. We know that, say, the treatment of the cancer is very expensive. So what happens that, say, in this e-platform, so you can have an advertisement that say this is my regular income and my son is suffering from the cancer, and I request all of you, say, to give some contribution to me so that I can use that amount for the purpose of treatment of my son. So there is a social cause with which, say, through crowdfunding platform, you will be able to raise the funds. That is what, say, the first, like the very noble cause that we have. At the same time, we have, say, something like this, that say, suppose I am a musician. Then I want to, that is, say, launch my own album, and I don't have the sufficient funds for the purpose of like creating or for producing that album. Again, I can go to this platform and I can ask from the investors that say, are you ready to finance me for my album? Whatever the cassettes that I prepare or whatever the CDs that I prepare, so that I will share with you. This is the way, so you will be able to, say, get the funds, and you can give return in form of, in the first case it is like the thanks that you tell them, and the second case you may give, say, something like this, that is whatever the product which you develop. If at all you want to write a book, even in that case you can give the copy of that book. This is what, say, we understand. Last but not the least is this, that what happens that, say, you will be able to that, say, get the financing, say, for your business venture also. Of course, whatever this e-platform that, say, you have, say, will charge you something, say, for the purpose of raising the funds. In addition to that, say, this is also governed by the Reserve Bank of India, and you will not be able to access, say, the huge amount of the funds from this. You will be able to access, say, some amount of the funds. But basically, say, when a small company is, say, developing, at that point of time, it may not be having the affordability, say, to launch itself, say, in a stock market, because that is very expensive. It requires too many disclosures, it requires like too many expenses. At this point of time, so this kind of platform is really making a sense. So crowdfunding is use of small amount of the capital from a large number of the individuals to finance a new business initiative. Crowdfunding makes use of the easy accessibility of the vast network of the people through social media and crowdfunding websites to bring investors and entrepreneurs together. Microloan are small loans that are given by the individuals at a lower rate of interest to business ventures. These loans can be issued by single individual or aggregated across number of individuals who each contribute a portion of the total amount. Vendor financing. Vendor financing is simple language. You purchase the goods on credit. That is vendor financing. Vendor financing is a form of financing in which the company lends money to one of its customers so that he can buy products from the company itself. Vendor financing also takes place when many manufacturers and distributors are convinced to defer the payment until the goods are sold. So defer the payment. This means extending the payment terms to a longer period. For example, 30 days payment period can be extended to 45 days or 60 days. However, this depends on one's creditworthiness and the payment of more money. Next is purchase order financing. The most common scaling problem faced by the startup is the inability to find a large new order. The reason is that they do not have the necessary cash to produce and deliver the product. Purchase order financing companies often advance the required funds directly to the supplier. This allows the transaction to complete and profit to flow up to the new business. Factoring. Simple factoring of accounts receivable means you appoint somebody, say, who will go and collect the receivable on your behalf, and by that time the factor is going to give loan to the company. That is the factoring. In this method, a facility is given to the seller who has sold goods on credit to fund his receivable till the amount is fully received. So when goods are sold on credit and the credit period, that is the date up to which the payment shall be done, is, for example, 6 months. Factor will pay most of the sold amount upfront and rest amount later on. So, like a substantial portion is paid on upfront basis and the rest is paid later on. Therefore, in this way, startup can meet his day-to-day expenses. So, this is the way we have the different methods of that is for raising funds. Let us see a kind of analysis. So the question number, then marks, remark, or we can say that chapter first of all. Remark in terms of toughness and time requirement. Question number 1A, a very simple question. Similar to this, questions have been asked or provided in the practice manual. Question number 1A, it is of 8 marks. We can say it is from the interest rate that we have, risk management, remark in that I would say that it is a very simple question and less time consuming. This time the question is providing that say simply you have to compute the interest by both the methods. One is the floating rate of interest method, another is a fixed rate of interest method, and then you are required to compute the difference which one has to pay to another. 1B, it is again a very simple question. It is of 8 marks, that is of the portfolio management. Again, very simple question. It is of 8 marks and very less time consuming comparing to the marks allotted to the question. 1C, it is again a theory question that we have. For theory questions, my always opinion is that it is less time consuming. The reason behind that is, even though you write everything that you are aware, you will be able to find some excess, that is the time available with you. Simple and less time consuming. Question number 2A, Okay, this is again a very simple question. Why? Because similar to this, questions have been provided by the institute. Even in your module, you don't have to refer anything else. So it is 8 marks question from Forex. As far as the foreign exchange exposure and risk management is concerned and international financial management is concerned, it is very much overlapping. So I am writing Forex, simple and less time consuming. Next is question number 2b. It is of the security analysis, security valuation. It is of 8 marks. Dividend discount model approach is required to be adopted by us. Security valuation, simple question, and again it is not very much time consuming. First of all, you are required to calculate the P0 before accepting the project, P0 after accepting the project. Then you are required to make the computation of the P1, P2. Then you are required to compute the number of shares to be sold at the end of each year. Lastly, you are required to make the computation of what would be the dividend income after entering into these transactions, and whether it is exceeding rupees 2000 or not, and what is the rate at which it will increase. Very simple question according to me. Once again, 2C, it is a theory question, 4 marks theory question. It is simple and less time consuming. Question number 3A. It is again mergers and acquisitions, extremely simple question. You have to make the computation of the EPS post merger and minimum required. 8 marks, mergers and acquisitions, very simple and too much less time consuming. And if at all you go with the shortcut method, it becomes yet more simple. 3B, it is from the mutual fund chapter. I would say that it is a moderate question in terms of the time requirement. Answer is simple, but I would say it is moderate. Why? Because every time you have to make the computation of the time period of holding investment, then date of making investment, yield, and so on. So slightly time consuming. 3C, 4 marks. It must be the theory question. Asset allocation strategies. 4A, it is of derivative chapter. 4A, I think it is of 8 marks. No, it is of 6 marks this time. It is from the chapter derivative. That is chapter number 8. Very simple. The reason behind that is, again, this kind of question has already been provided by institute. There is nothing great or nothing new that we have over here to learn. 4B, it is of the, I think that it is of 10 marks, 8 marks, okay. So 8 marks, it is from the chapter of mergers and acquisitions, because the economic value added concept is transferred over there, EVA. I would say that it is an excellent question, because we have been provided with the beta of the unlevered equity. Based on that, we have to find the beta of the levered equity. We are required to find the cost of equity. We are required to find the weighted average cost of capital. We are required to find the operating income, and so on. We are required to make the calculation. And I would say it is moderate time consuming, not like great, but this is a very good question which I have found over here, say in this examination paper. And I think that this is what one of the reasons that we are doing this kind of examination, that is papers. C is again a theory question, 4C. In which we have say some practical application also. Next, question number 5A. In that, friends, due to the concept of the joint probability, the question became very lengthy. However, that was really an important and a new point that we had in examination. Given a choice, I would say that this is what's a question that you should skip, considering that's the time requirement that we had. It is of portfolio management. I would say that it was a good question and it was time consuming. Time consuming, more I am writing. Five B. And that again, similar to this, number of times a question is asked. It is from the securitization chapter. That what are the issues with respect to the implementation of the securitization? Question number 6A. Next question. Six C is also a theory question. 5C, I'm sorry, which I forgot to mention. 5C is also a theory question. Then 6A. In 5C, we have two options. That is, out of two, we have to answer one. Question number 6A. That was really an excellent question, I would say, for an exchange risk management. Dear students, similar to this, the questions have been asked by institute. It is there in your module also. However, the 25 lakh rupees of the excess funds that you have, that was a new point in this question. So it was a good question, and I would say that it was moderate time consuming. Six B. Okay, that was a simple question of the derivative. That was again a simple question. The question similar to this has been provided to us by the module. In that, so they have provided directly the standard deviation. This time the variance is given, but at least now at CA final level you are expected to have application of that much. That's the variance is converted to the standard deviation. Next, that is also like question asked for number of times from the startup. It is simple and less time consuming. My suggestion to all of you is my subjective suggestion is that say you may leave question number 5, because question number 1 is compulsory question that you need to attempt. Then from question number 2 to question number 6, one question that we can skip, and that is what say the question number 5 that we have to skip. We should skip according to me. For each of the question you can see that the marks weightage is 20 marks. 8 plus 8, 16, 16 plus 4, that is 20. Again same. Over here the individual bifurcation changes. 8 plus 6, 14 plus 6, that is 20. Over here it is again 20, and over here it is again 20. That is what we have. At least say that is one theory question every time. So we can say that there are 5 questions that we need to attempt, and 4 marks is a theory for each of the question. So 4 into 5, that is the 20 marks theory. So we can see that, say, over here it is the theory. Over here it is theory. This is the theory question, 4 marks. This is the theory question, and it is of 6 marks. So we understand that, say, if at all you don't skip question number 4, then in that case the theory portion will further increase. Okay. If you attempt 4th and not, that is, if at all you leave 4th and you don't leave the 5th one, then theory will further increase. So it is 4 into 5, 20 marks is minimum. It may increase from 20 to 22, it may increase from 20 to 24 even. This is a theory question. So all of you must have understood the significance of the theory. In no case we can afford to leave the theory. This is what we have is the October 20 examination paper that we have.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.